Okay. Good morning, everyone. Sorry for the 5 minute delay, some technical issue. Okay. So we continue our session yesterday. So if I have to just give a brief recap of what all we discussed in yesterday's session, well, we started off with the introduction to Ind AS 19 that basically deals with employee benefits. We saw who is covered in the definition of employee. It includes full-time employee, part-time employee. It also includes your directors, managing director, whole-time directors. Okay, so it basically includes anybody and everybody who is under the who is falling under the ambit of an employee. Okay, so what is essential is there must be an employer-employee relationship. We are doing the accounting as per Ind AS 19 in the books of the employer organization. Okay, so basically it is an employee benefit expense that we are looking for accounting. Okay, so this is what is applicable. Okay, so why did we have Ind AS 19? What was the objective? Well, basically, there are certain normal expenses like salary, PF contribution, ESI contribution. These contributions are on a monthly basis, so accruing them would not have been difficult. But certain expenses like gratuity, leave encashment, pensions, etc., these expenses are paid post the employment. Okay, and that is why guidance was needed in this regard. The main pivot behind which Ind AS 19 revolves is the accrual principle. An employee has given you the service, so you must record the cost matching the benefits that are derived from the services provided by the employees. So for instance, if he has given service and you are remunerating him, your remuneration will be in the form of salary, could be in the form of contribution to provident fund, could be in the form of contribution to ESI. Your remuneration could also be in the form of pension or gratuity. Only thing is these costs are being deferred to a future period, and that is why Ind AS 19 guidance is needed to do the accounting for employee benefits. Okay, so what all is covered we have seen. It excludes Ind AS 102, that is employee share-based payments, and it excludes accounting and reporting by the employee benefit plans. Okay. So when I talk about classification of employee benefits, there are broadly four types. One is short-term benefits like salary contributions. Okay, so these have to be paid off within 12 months. No discounting is needed. Then you have post-employment benefits like pension and gratuity. Then you have other long-term employee benefits and termination benefits. Okay, so these are the four broad categories under which we are going to discuss. When we saw short-term benefits, the accounting for this is pretty much straightforward. There is no need of any actuarial assumptions, no discounting, nothing is needed. You just have to do a straightforward accounting, expenses account debit to liability if unpaid, or to cash bank if it is paid off. Okay, so this is the entry that you will pass. In case these employees are used for building or constructing a self-generated asset, in such a case, as per the Ind AS 16 or Ind AS 38 or Ind AS 40, you will end up capitalizing the cost. Okay, otherwise it will generally go into your employee benefit expense, which goes to the profit and loss. In short-term employee benefits, we also discussed separately something known as short-term compensated absences, which is basically leave encashment or the benefit of leaves that is available. So we are having two categories. One is non-accumulating, the other is accumulating. Non-accumulating means your leaves have to be taken during the year, otherwise they end up getting lapsed. So if they lapse, the employee is mandated to take these leaves. If he doesn't take, he's not going to get any cash in lieu of the extra time that he has worked. So technically speaking, when he takes the leave, you're having an obligation. So therefore, you will recognize the expense based on the absences occurred. Okay, so that is how the treatment goes. Fairly simple, no confusion. When we talk about accumulating absences, this is basically the leaves which can be carried forward to the future period. This is again divided into two types. One is vesting, where you get cash in place of leave, and the second is non-vesting, where you are entitled to carry forward the leave to the subsequent period. Okay, so when you talk about cash in place of leave, that means if the employee, suppose he's entitled to 10 days of leave in a particular year, he has taken only 8 days and he has not taken 2 days leave, then for that 2 days leave, he would have come to the organization and rendered the services for which he will be compensated. So therefore, the expense of that 2 days is recognized based on the services that he has rendered. That means he's come to the organization and served, he has given benefits on those 2 days. So to match those 2 days benefits, you are going to give him an employee benefit in the form of leave encashment. So this is vesting. When you talk about non-vesting, it is basically carry forward of these leaves. So in our example, if out of 10 days he has taken only 8 days, the 2 days leave is carried forward to the next year. Next year's entitlement is again 10 days, but he can now avail 12 days because he has taken 2 days less in the coming year. So how do we do the accounting? We base our accounting on estimate. We assume that based on past experiences, we should have the data available with us. If he has taken 2 days leave, we will have to think whether he will avail these 2 days in the future or not. Okay. And if he is going to avail these 2 days in the future, then what we are going to do, we will today make a provision of leave encashment to the extent of 2 days. And in the next year, when he takes 10 plus 2 days, we will reverse the 2 days entitlement and make the payment to him in the next year accordingly. Sir, what if the estimate goes wrong? 2 days bola tha, but he takes only 1 day. Well, if you take 2 days and he takes only 1 day, or you estimate 2 days and he takes 3 days, for example. Okay. If this is the scenario, then you record whatever differential is there in the next year as a change in accounting estimate and give a prospective impact. It is a change in estimate. Okay. See, if I had to be very conservative, I would obviously say, yaar, jitne ka entitlement hai, you take it entirely in the next period, assume that it is done and record the complete liability. That is the simplest thing you can do. But Ind AS 19 moves towards a more realistic sense of accounting. It tells us, why do you want to assume the worst in all cases? There may be some employees who have never utilized the leaves to the fullest extent. So you are having a valid basis to estimate that, say, out of 2 days, he will always utilize only 1 day extra. There is no proof that he will utilize all the 2 days. So you can go ahead and do that assumption in the future. Okay. And account for as an additional 1 day expense right now. If he takes 2 days in the future, fair enough, you take it as next year's expense on account of a change in accounting estimate. Okay. So this is how you do the accounting. Typically, it is going to be a game of estimates in the first year. So there is always a chance that your profits can be dressed up, your profits can be manipulated because of these assumptions. Okay. So we did some illustrations regarding this. I had given you some homework. I hope you could do that. Then we come to short-term employee benefits in respect of profit sharing and bonus plans. So sometimes organizations provide bonus. Okay, bonus could be in the form of distribution of profits as well, but distribution of profits cannot be regarded as dividends because this is the bonus paid in the employees in their capacity of employees, not in the capacity of shareholders. So therefore, it will be treated as an expense. Even if there is no written obligation, if there is a practice of giving the bonus, you will have to recognize the liability because it becomes a constructive obligation in that case. Okay. So I told you to do this for homework. We did illustration 8. Okay. Then we came to post-employment benefits. When we talk about post-employment benefits, they are broadly categorized into two parts. One is defined contribution plan and the other is a defined benefit plan. When you talk about contribution plan, you can think in your mind that it is something similar to a provident fund. Okay. So the employer contributes the benefits in a provident fund. And on retirement, resignation or superannuation, the employee will go to the PF trust to get the money back. Okay. So in this case, the investment risk lies with the employee, because employee is putting the fund in a PF trust. The employer's organization's liability is restricted to making the contributions. Once it makes the contribution, employer will say, bhai, I have done whatever I had to. Now, whether the money is more, whether the money is less, that is all not concerned with me, because I have parked my money in the PF trust. The trust would make subsequent investments. It could make investments in fixed deposits, government securities, gilt-edged securities. It could make investments in treasury bills. It could make investment in equity. It could make investment in debt. It could make investment in corporate bonds. Wherever it wants to, it can make the investment. But the ultimate impact of this investment is going to lie with the employee. Okay, the PF trust will say, we invested so much, but itna hi return mila. This return we are passing on towards you. So this is what is known as a defined contribution plan, where investment risk lies with the employee. Actuarial risk also lies with the employee. Suppose I invest in fixed deposits and I notice that the market rates have changed because of RBI announcements. So automatically my investment in fixed deposits also get impacted, and this becomes an actuarial risk. The change in the market rates. Okay, so this actuarial risk is also going to impact my employee in some or the other way, and that is why defined contribution plan is always risky for the employee to some extent. Okay, coming to the other one, that is a defined benefit plan. We call it for example gratuity or pension or whatever it is. So in this case, your gratuity is computed based on a plan formula. Okay, like 15 days salary for the completed year service. Okay, so for each completed year of service, this is how gratuity is computed with a maximum cap of 20 lakhs. So now the amount is defined. The employer has to pay the employee this particular amount. He cannot say that मैंने invest नहीं किया, मेरे पास पैसे नहीं है, मेरे पास, I did not plan it out, I'll pay you later on. All these things will not going to work. The ultimate obligation rests with the employer in this case. Okay, so how the employer manages whether he wants to invest the money, if it invests the money somewhere, the investment risk is on the entity. If the market rates change, the impact of that is felt by the entity itself, and therefore all the investment and actuarial risks are there only on the entity, not even the employee. Employee is safeguarded. Employee is going to get what is due to him genuinely. Okay, so this is where certain benefits are agreed to be provided. Okay, when you talk about accounting, contribution plans are fairly simple to account because it is just monthly accrual of the dues that you have to make. Whereas when you talk about defined benefit plans, which we are going to discuss in detail right now, there is a lot of complexity that are involved in the accounting. There will be actuarial assumptions, there will be discounting that will happen. Okay, so that is what we are going to now look at. Okay. So I told you to do these questions for homework. This theory I told you to read. I'm not sure whether you guys have done, but it is just theory and it should be able to, you should be able to understand. So if you have to account for defined contribution plans, the entry will be expense account debit. If it is used for constructing an asset, the expense will be taken to the asset account. Credit your cash bank. If you have paid excess, it will be prepaid. If you have not paid, it will go and sit as a liability. Okay, so I hope that you did illustration 11 also. Kuch nahi, it's a very simple question. Okay, so basically total annual gross salary is 50 crores. 12% of the gross salary means your contribution should have been 6 crores. You have paid 2.8, so the balance 3.2 will remain as a liability, as a current liability in your financial statements. Okay, have you guys understood so much? Yes. Could you, I had also told you to try question number 5. Could you do question number 5? Did you guys try question number 5, or you want me to do question number 5? Yes. Did you try question number 5, which is there in your test your knowledge section? Yes, Kaushiki, Rashmi. Who all are there? Shailendra, if you are there. Did you guys try question number 5? Yes. Okay, fine. Looks like you guys have not tried. No problem. We will be doing it right now. Okay, so let us start. Syska Private Limited has a head count of around 1000 employees in the organization in 20X0X1. As per the company's policy, the employees are given 35 days of privilege leaves. Okay, 35 days of privilege leaves, 15 sick leaves, and 10 casual leaves. Wow, very good. Out of the PL and sick leaves, 10 privilege leaves and 5 sick leaves can be carried forward to the next year. Okay, on the basis of past trends, it has been noted that 200 employees will take 5 days of privilege leave and 2 days of sick leave. 800 employees will avail 10 days of privilege leave and 5 days of sick leave. Okay, so this is the estimate. Okay, this is the estimate. What would be the treatment of the short-term compensating absences? This is the first part. The second part is profit sharing plan, which is basically this paragraph. And the defined contribution plan, this is basically the third part. We have done all of this. So let us now quickly look at how to do the accounting. Okay, so now it's very simple, not at all difficult. Figures bhi utne zyada nahi hai. Okay, so I am having first category 200 and 800 employees. So 200 employees in the future are going to take how many privilege leave? If I talk about privilege leave, 5 days. And if I talk about sick leave, they are going to take 2 days of sick leave in the future. This is the data that they are having with themselves. Okay, for 800 employees, for the remaining 800 employees, they will avail 10 days of privilege leave and 5 days of sick leave in the future. So this is how you are going to avail the leaves in the future. Okay, 200 employees, 5 days privilege, 2 days sick leave, 800 employees, 10 days privilege and 5 days sick leave. So now, how do I do the accounting? Very simple. You record the corresponding salary amounts. They've not given the salary amounts. Okay, so I cannot record that. What you will have to say is, we should recognize a liability of privilege leave to the extent of 5 days and sick leave to the extent of 2 days in respect of 200 employees. And we should recognize a liability to the extent of 10 days and sick leave to the extent of 5 days in respect of 800 employees. This is basically the unused leaves that are there in the current year, which are expected to be utilized in the subsequent year. Okay, so that is how it is given. If they had to give you the salary that is there, then we would multiply these leaves with that salary to arrive at the actual liability amount to be booked in the future. Is it okay? Have you guys understood this part? Yes, all clear? First part is understood. What is the treatment of short-term compensating absences? Any doubts? Is the first part clear? Yes. Okay. We then move on to the next part. The company has been incurring profits since 20XX. It is decided in X0X1 to distribute profits to its employees at 4% during the year. Malab, when the year started, they thought that we will distribute 4%. However, due to the employee turnover in the organization, expected payout is expected to be around 3.5% only. So the profit earned during X0, X1 is 2000 crore. So therefore, the bonus that you are giving, it is a profit sharing bonus, 2000 into 3.5. Sir, but 4% you would have taken if the attrition would not have been there. Since there is attrition, the overall reduction is 0.5%. So therefore, you will take it based on 3.5%. So that comes to how much? That comes to 70 crore. You will have to book an expense of 70 crore. If it is paid off bank, if it is not paid, credited to the liability, it will be paid in the coming year. Okay. So this is 2000 into 3.5%, that is 70 crore. Coming to the third one, Syska Private Limited has a post-employment benefit, which is in the nature of a defined contribution plan, where contribution to the fund amounts to rupees 100 crores, which will fall due within 12 months from the end of the accounting period, which will fall due. Okay. The company has paid 20 crore to its employees in 20X0X1. So very simple, expenses 100 crores, liabilities 100 crores, but I have paid off 20. So therefore, 100 minus 20, 80 crores is outstanding. So you will pass the entry employee benefit expense account debit to outstanding contribution to the fund 80. And then you will pay it off in the next year. Have you understood all the three treatments? Yes. Have you understood all the three? Rashmi, Kaushiki, where are the others? Have you understood all the three treatments? Yes. All clear? Please confirm. Okay, fine. So that takes care of question number 5. Very simple question. Question खाली दिखने में बड़ा रहता है, but it was quite simple. Okay. So coming to the next part, that is a defined benefit plan. So take a typical example. We had discussed this yesterday. Okay. So I'll just revisit it quickly. So take the case of an employee who has joined on 1st April 16, expected to retire 31st March 50. You are reporting for the year 2019-20, and you are having obligations like gratuity, pensions, etc. So this employee will remain for 34 years. Now the question is it so simple to account for a liability? No. Why? Because one, you do not know whether he will be there with you or not. He could leave the organization. So labor attrition is one problem. You do not know whether he will be alive or not, mortality. You do not know whether he will be able to work, disability. Then you are going to make the payment after 34 years, assuming he is going to be alive, mortality, he won't be disabled, etc., etc. Then also you are going to make the payment after 34 years. Aaj ke tarikh mein, if you have to provide it, you will have to discount it to the present value. So discount rate is an assumption. Second, what is the salary today will not be the salary after 34 years. Salary will increase. So you will have to make estimate not only of salary increase. You cannot say 10% every year we will increase. Hurry, your increase depends on performance of the company, performance of the individual, inflation rates prevailing, basis which you compute, say for example, your dearness allowance, any allowances that you give, any tax impacts that you foresee, all these things together will decide what will be the remuneration of this employee at the end of the 34th year on 31st March 50. So the benefit levels is also a very onerous task to compute, and it is going to be pure estimates. Okay. Then next, because you have to make the payment after 34 years, you will obviously set the money aside. ऐसा नहीं होना चाहिए every year you book an expense, that is expense account debit to outstanding, and At the end of 34th year, your P&L has suffered the hit, liability is there, but आपके पास hard cash is not there. You don't have cash to make the payment. So what organizations do is typically they park their money in an investment. Investment could be something as simple as a fixed deposit or something more than that, like equity or mutual funds, whatever. Okay. So if they park their investments, they will get some return. On that return, you are going to have income tax payable. So that is something which you will have to foresee. Okay. And various other estimates. So yeah, basically what I want to say is it is not easy to estimate. It is not easy to estimate all these things by us. Okay. So I told you to do this question also as a homework. Okay. Basically, crux of this question is in one organization, there is a lot of labor turnover. So the employer did not account for gratuity liability on accrual. It accounted for it on payment basis, saying that attrition is very high. It becomes difficult to estimate. That is why you have to do that. Okay. See, Ind AS 19 cannot say, you cannot avoid Ind AS 19 by saying there is a lot of labor attrition. 5 साल भी खत्म करेंगे कि नहीं अपने को नहीं पता. That is what you have to estimate. Okay. So there is a lot of complexities which are involved. So you cannot say that I'll follow payment basis because of difficulty. You have to follow the accrual basis regardless of the difficulty and then proceed to do the estimation Okay. All right. So now coming to the most important part, we had seen part of this accounting for the defined benefit plan. And I think I had taken an example to explain the working. Okay. I had taken an example to explain the working. Let us just revisit that example. Acer Limited hired a professional for 6-year period, and at the end of the 6th year you are going to pay a lump sum remuneration of 45 lakhs. So accounting for this 45 lakhs, how am I going to do? So one thing, a couple of points. Is the 45 lakhs a known liability? Yes. Is it arising today? No. Is it arising at the end of the 6th year? Yes. But does it relate to only the payment that is due? Does it relate to service provided in the 6th year, or does it relate to services provided over the 6-year period? Answer is it relates to services provided over the 6-year period. And therefore, you cannot suddenly hit your P&L in the 6th year only. You will have to gradually build the liability. So for this, we follow something known as projected unit credit method, PUCM, projected unit credit method. Okay. So basically what I do is each service period, I will attribute some portion of the benefit that I'm going to pay. That 1 unit of the benefit is what is known as unit credit. Okay. So I am going to estimate this unit for the next 6 years in this example. Okay. Since I'm estimating projected, so projected unit credit. So 45 lakhs I have to pay, which is for 6-year service. So 45 by 6, 7,50,000. So the value of each unit is 7,50,000 in future value terms. The value of each unit is for 7,50,000 in future value terms. Okay. So once that is done, that is attributing the benefit to the periods of service. But itne se kaam nahi banta hai. What is the issue is 45 lakhs is payable after 6 years. Since I am calculating the obligation now, it's mandatory for me to discount. So discount rate kaun sa use karna padega? Well, discount rate could be your risk-free rate of interest or FD rate, whatever it is. In our example, we are given that it is 10% per year. Your question will always give you the discount rate. So now how do I do the discounting? Okay. It's not going to be a normal straightforward discounting. We follow a reverse discounting. The liability of 7,50,000 arising in the 6th year will be paid in the 6th year. That is why the discounting rate is 1. The liability for the 5th year will be paid in the 6th year. So this is the discounting for the first year, 0.9091. Likewise, we proceed to do the discounting for the remaining 4 years. Okay. And then we do a multiplication to arrive at the present value. So 7,50,000 into 0.6209, this gives you 4,65,691. Have you understood this part? Yes. So this becomes the closing balance. This becomes the closing balance. Next. 7,50,000 into what is the next discounting? 0.683. Okay, so that gives you how much? 0.683. That gives you 5,12,260. So I am multiplying this figure with the discounting rate to arrive at something known as current service cost. To arrive at something known as current service cost. Sir, current service cost का मतलब क्या होता है? Current service cost is essentially the efforts that the employee is putting, which is giving rise to the gratuity liability in the future. Basically, you have to understand that 45 lakhs, the payment which is going to happen is having two components. This is having two components. Any payment, okay, like this is 45 lakhs guaranteed amount. You talk about gratuity, you talk about pension. These things are basically having two components. One is, आज की तारीख में your employee is doing वर्क, प्रोवाइडिंग सर्विस. आज की तारीख में वो मेहनत कर रहा है, उसको हम लोग बोलेंगे current service cost. This is basically the benefit, the service that he is giving you is giving rise to his entitlement to get the amount in the future. Because he's working today, he's entitled to get the gratuity amount in the future. तो उसको हम लोग बोलेंगे current service cost, the effort that he is putting, the service that he is rendering. Secondly, since there is a huge time gap that is involved, the obvious thing that is also there is finance cost. The obvious thing also there is finance cost. You can take it in two terms. Employee is working now to get a payment in the future. Okay, so basically if I talk from the perspective of the employee is doing work today, but he's not getting this payment right now. It is kind of saying that he is telling the employer, give me the payment after 6 years. But he will say payment after 6 years will not be based on today's service cost. It has to be increased for the interest. It has to be increased for the interest. Okay, so this is one way of interpreting it. The other way is straightforward. You have to pay 45 lakhs after 6 years. So you do the discounting. Okay. So current service cost is purely related to the efforts put, services rendered. And then you are having something known as a discount factor. So you start unwinding the discount over the 6-year period. So 4,65,000 into 10% applied on the opening obligation. So everywhere I have applied it on the opening obligation. At the end of the 6th year, you are having a liability of 45 lakhs. Okay. So illustrative treatment, employee benefit expense account debit. This is the current service cost. Then you have finance cost, which will also go in employee benefits only. You have not taken a loan. This is not a loan which you have taken. This finance cost is attributable to employee benefits, which you are going to pay after a 6-year period. So that is your interest cost or finance cost. And credit what? You will credit provision for employee benefits. This is how you do the accounting and building up of the liability. Okay, and building up of the liability. Okay, so now if you look at the illustration, we had just diagrammatically presented it. So 7,50,000 is the unit. Discounting it gives you the current service cost. उस मेहनत का आज के तारीख में value कितना है? The value, the monetary value of the service provided in today's terms, how much that is known as your current service cost. Then you do the interest cost every year at the rate of 10%. So that is going to build up to a liability of 45 lakhs. And I suppose this was where we had ended yesterday's discussions. Is it okay? Have you guys understood this part? Yes. Please see the homework questions. I have left only theoretical questions to you. Okay. So far, is it clear? Have you guys, I recapped what was done yesterday and done one or two questions where you were not sure. I discussed the defined contribution plan build up also in another time. Okay. Because yesterday I was not personally very satisfied. Okay. So is it okay? Have you guys understood the whole crux of yesterday's discussion? Yes. Rashmi, Kaushiki, Shailendra. Have you guys understood yesterday's discussion? All clear so far? Anybody has any doubts? Yes. Okay. All clear. Fine. So that is how you slowly start to build up the liability. You slowly start to build up the liability. Now, when we start to calculate the cost of the benefit is 7,50,000 per annum in our example. Okay. 7,50,000 per annum, or you can say 45 lakhs. Or you can say 45 lakhs, or you can say discounted value also. You can say discounted value also. Okay. So this is what is the ultimate cost that is hitting. This is what is the ultimate cost that is hitting. So when I have to calculate the discounted cost, or the ultimate cost. Okay. I'll use the term ultimate cost. Okay. Basically, there are two things which the organization has to assume. First thing is demographic assumptions. The second one is financial assumptions. बैठ के सुनो, it's quite simple to understand. Demographic assumptions means assumptions relating to a person, assumption relating to the physical attributes of the person. Okay. For example, mortality rates. Okay, you remember, or probably you will see in the future, when you are going to join an organization, your HR is going to give you a form jisme you will have to do a lot of data filling, like what is your blood group, what is your what you can say, what is your any pain points regarding your health, etc. वो ऐसे नहीं होता है. This data is going to help in making the demographic assumptions. Okay. For instance, they will look at your background. They will look at your latest jobs. How often do you skip? How often do you skip is not necessarily on a negative perspective. Skip means how often do you hop the jobs? Okay. It is also going to have an impact on the demographic assumptions. Okay. So if an employee has joined and his past history indicates that every 3 years to 3.5 years he has shifted the jobs, then it definitely indicates that probably this fellow is never going to be entitled to gratuity, because for gratuity you need 5 continuous years of service. So that is what is known as a demographic assumption. That is what is known as a demographic assumptions. It is an assumption, it is an estimate, it can go wrong in the future. Okay. There may be a chance that a 3-year hopping employee may continue with your organization for 5 years and be entitled to gratuity at the end of 5 years, in which case you will have to record the change in estimate in the period when the liability actually arises. But you are going to make these assumptions. Okay, you have to. So mortality rates, some organizations ensure you have a thorough medical checkup. The report shared with the organization will help them to estimate the mortality rates, rates of employee turnover, disability, and early retirement. Then probably if you are hiring a female employee, You will look at her age. You will look at the fact whether she's, for instance, married or unmarried. If she's unmarried, then you will probably consider whether she will continue or not. In fact, that is one of the questions which is commonly asked by the HR. Are you married? And secondly, if you are married, if your marriage is known, will you be continuing in this, or will you be going out, or will you be going out of the state or out of the place? If that is the case, it will give them a better understanding. It will give them a better understanding of how the assumptions should be made, Okay, so mortality rates, employee turnover, disability and early retirement, proportion of plan members with dependents eligible for benefits, proportion of plan members who will select each form of payment under the available plan terms, and claim rates under medical plans. So this is something which are known as demographic assumptions. Moving on to the next one, financial assumptions. You could be having assumptions like future salary. How much are you going to increase? In what rate? What is the impact of inflation? All these things you will consider. Discount rates to be in nominal terms unless real terms are more reliable. For example, in case of hyperinflation. Future medical cost you will have to consider. Taxes payable. All these things you will have to consider. Okay. So these are known as actuarial assumptions, which are broadly divided into two types, demographic and financial. The question is, can these actuarial assumptions change over time? Obviously they can. वो assumption hai, it's not reality. It can change. For instance, you have assumed that the salary is 10 lakhs after 30 years. But over the time, you are happy with the performance. You will give him a raise. You will then see that at the end of the tenure, instead of 10 lakhs, he becomes entitled to 12 lakhs. So that is a change in the future salary. Future salary is an actuarial assumption. So actuarial assumption can change over time. Actuarial assumption can change over time. So basically it's divided into two things. One is experience adjustments and the other is effects of changes in actuarial assumptions. So experience adjustment means as and when you get new information, new data, these data will start impacting your assumptions. And when these impact your assumptions, the ultimate impact is going to be on the liability that you are recognizing. See, suppose I have decided that the liability will be based on 15 days of last drawn salary. 15 days of last drawn salary for each year of service. For each year of service. So in this plan, what is known to you, bhai? आपको पता क्या है? Last drawn salary, I do not know. I am estimating. For each completed year of service, I do not know. I am estimating what I have to pay. What I am estimating how many years the employee is going to live. It is very easy for me to estimate a 59-year-old employee. We will obviously say he will complete 60 years because now there is no sense for him to leave the organization. But for an employee, say a 35-year-old employee, whether he will be there until he completes 60 years or not is very difficult for me to assume. And therefore, these assumptions change. These assumptions change with each new information, with the experience that are there. So this change happens on account of experience adjustments, which is an actuarial assumption. So where do you give the effect of changes? This effect is going to go in other comprehensive income without reclassification. This is going to go in other comprehensive income without reclassification. Okay. Let me give you the reasoning why they are taking it in other comprehensive income. And let me also explain why it's not reclassified. Why it's not reclass. Reclass means what? It has to move from other comprehensive income to the profit and loss. Yahan pe reclass is not permitted. See, actuarial assumption, इसमें से you look at each and every factor. Mortality rates, do you have a reliable data? Answer is no. Employee turnover, do you know what will happen? Pandemic like COVID happened. You have to throw out some people, hire some people. They will move the jobs within the COVID period. No certainty about turnover, no certainty about disability, retirement. Who is dependent on the plan members? Claim rates under medical plans. Nothing is certain. Nothing is certain. Discount rates, future salary, future medical cost, all these things nobody knows. Nobody knows. Nobody can predict with accuracy. So what entities could do is, देखो ये सब assumptions का खेल है. It's everything about assumptions, everything about estimates. So what entities could do is, in a year when the profits are less, they could probably change the assumption. They could change the assumption in a manner that the future liability goes down, expense to be booked goes down, and profit could be made to increase. This was creating a problem because the results were getting manipulated. The results were getting affected because of this manual interventions. So what Ind AS 19 did was, there is any change in actuarial assumption, kuch mat karo, throw it in other comprehensive income and don't allow reclassification to P&L. Very straightforward. Now you want to increase the assumption. I mean, you want to increase the future salary, decrease the future salary, do not impact the salary. Whatever you want to do, you do, because ultimately the impact is going to go in other comprehensive income, which will not be reclassified, Okay. So that was the reason this was there. In AS 15, what used to happen was this actuarial assumption impact, change in actuarial assumptions, it was hitting the P&L because in IGAAP, there was no concept of other comprehensive income. So my P&L used to start getting impacted. My results were getting impacted because of this. And that is why here the change has come to recognize it in other comprehensive income without a reclassification permitted. Is it understood? Yes, because assumptions to kisi ke haath mein nahi hai, right? So that was a very good move. Okay, that was taken as a part of the standard development. Okay, coming to the next part, you will have, okay, so this is relating to salary increases. You will have to look at obligation on a basis that reflects benefits as per plan terms, estimated salary increases, limit on the share of cost of future benefits, contribution from employees or third parties, effect of changes in the state benefits. Okay, so in respect of future benefit changes which are of a formal nature, they should reflect such changes. Actuarial assumption should reflect such changes. Example, past history of increasing benefits as per inflation rate. If it is informal, such changes should not be reflected. Okay, such changes should not be reflected. Limit on employer share imposed on the contributions. Effect of a limit on the contributions is determined over shorter of life of entity and estimated life of the plan. ये सब theory है. It's not going to be very important. अपने लिए पढ़ना है, पढ़ सकते हो. Okay. I have just encompassed the entire standard here. Okay. Coming to the next one, actual assumptions relating to mortality and medical cost. You can just go through to see what is there that is impacting my actual assumptions on account of these two. Okay, so using your cost that is going to come in the future based on the actuarial assumptions, you determine the unit of benefit for each year. And the unit of benefit for each year, once you have determined that, you will then have to move on to do the accounting of that. Okay, any change in the for example actuarial assumption, impact of that goes to other comprehensive income. Okay, so what I want you to do is do this for homework. It's just a theory question. Apne liye hai, no problem. You will understand it very simply, okay, in a very simple manner. Okay. Coming to the next one, that is, I have an example for all of them. Okay, so don't worry about, sir, ये तो सिर्फ theory चल रहा है. Okay, past service cost. there is a change in the present value of the defined benefit obligation. In our example, the benefit obligation, remember that question, the defined benefit obligation was 45 lakhs after 6 years. 45 lakhs after 6 years. Now I can keep this. Okay, I can keep this, or this defined benefit obligation can change on account of two things. One is change in actuarial assumptions. If this is the case, this goes to other comprehensive income without reclass. The other thing is, it could be on account of past service cost, and the past service cost could be on account of plan amendment or plan curtailment. Plan amendment or plan curtailment. So what do you mean by plan amendment? There is a change. There is a change in the benefit. So suppose you are so happy with the performance that आप बोलोगे 45 के बदले में I will give you 50 lakhs. And this you decide it in the third year. You decide it, let us say, in year 3. Yes. So now what happens is you are increasing the obligation. You are increasing the obligation in year 3. So now tell me, have you amended the plan? Yes, you have amended the plan. Is this in the nature of an assumption? Answer is no, it's not in the nature of an assumption. If it is not in the nature of an assumption, what you will have to do is you will have to record the change in the benefit. The change which is on account of a manual intervention, which is on account of a decision. Okay, so this impact, I will not take it to other comprehensive income. This impact will start hitting my P&L. This will start hitting my P&L. Okay, so your expense is going to include, your expense for the period is going to include two things. One is the current cost, that is the current service cost. The other one is the past service cost. See, in years 1 and 2, year 1 and year 2, you have recorded the expense based on an obligation of 45 lakhs. In third year, the obligation becomes 50 lakhs. That means the shortage that you have not provided in year 1 and year 2 relating to the present value of the additional 5 lakhs will now be recorded in year 3. That is not shooting up year 3 purely because of year 3 change. It is shooting up year 3 benefits because of past service cost of year 1 and year 2. If I am happy with the performance till the third year, it means I am happy with their performance in year 1 and year 2 also. So that differential is known as your past service cost. That differential is known as your past service cost. Where are you going to record it? You will be taking it to the profit and loss. You will not take it to the other comprehensive income. Okay. Curtailment means reduction in the number of employees covered by the plan. Okay. So what is excluded from past service cost? Obviously, actuarial assumptions are excluded. Actuarial assumptions are excluded. Estimated costs are recognized as current service cost as the service was rendered. Okay. Actuarial gains are already recognized, such gains. Okay. So basically all these things relating to actuarial assumptions, etc., are excluded from the definition of past service cost. Okay. So fairly simple. Let us now look at a related example as to how we are going to interpret this. Okay. Ratna Limited pays a lump sum benefit on termination of service equal to 1% of final salary for each year of service. Salary in year 1 is 1 crore, assumed to increase at 7% per year. Discount rate is 10%. Show the buildup of the obligation in respect of an employee who is expected to leave at the end of year 5. Ignore all actuarial assumptions other than the given discount rate. So this becomes first part. We have to show the buildup. Ratna wishes to revise the percentage of benefit from 1% to 5%. Discuss the impact of this change if the benefit was revised at the end of year 2, if the benefit was revised at the end of year 5. So this is now a change. Tell me one thing. The revision in the percentage of benefit 1% to 2.5%, is this an actuarial assumption? Is this change percentage of benefit an actuarial assumption or not? Is this an actuarial assumption or not? Okay, it is not a, so what is changing is this 1% is increasing to 2.5%. It is not an actuarial assumption. It is a fact which you are changing. And because this fact is changing, where are you going to recognize the impact of this change? You will obviously recognize the impact in P&L. Last drawn salary estimate, they are saying assume to increase at 7% per year. Years of service expected to leave at the end of year 5. Yes, so these are assumptions. So these two things are actuarial assumptions. इनमें से कुछ भी change हो जाए, anything changes, yes, if anything changes in respect of last on salary estimate or years of service expected to be there, then the impact of these changes will be taken to the other comprehensive income, So let us look at how this particular case pans out. Okay, so now see, first thing is you will have to determine the ultimate cost of benefit. Then we do the attribution to each period. Then we do the discounting. Okay. So they are saying that salary in year 1 is 1 crore, expected to increase at 7% per year. So year 1, it is 1 crore. Year 2, plus 7%. Year 3, plus 7%. Year 4, plus 7%. Year 5, plus 7%. Okay, so this is how the salary is going to move. So many students end up making a mistake when they look at this. 1 crore into 1.07 raised to 4 it is. You are multiplying 1.07 4 times. So you can also say 1 crore into 1.07 raised to 4. Many students make a mistake. They write here 1 crore into 1.07 raised to 5. Raised to 5. That is not what is happening here. The change happens from year 2 onwards. Okay, so this is going to be the revised salary at the end of year 5. Okay, 1 crore 31 lakh 7,960. The cost of benefit on termination is 1% for 5 years. Okay, initially kya tha? 1% of final salary for each year of service. So 1 crore 31 lakh 7,960 into 1% into 5 years. So that means your benefit which you will pay later on is 6,55,398 rupees. Okay, this is the liability after 5 years. So you will have to build up the obligation. So far, is it clear? Yes, so far is it clear? Any doubt so far? Any doubts? Any doubts? Okay, all clear. Now we will have to attribute it. Is the 6,55,000 related only to year 5? No, it is related to services provided over a 5-year period. So we will have to do the attribution. So divided by 5. So every year we will attribute 1,31,080. This is obviously in future value. This is obviously future value. We will then have to do the discounting to the present value. Rate is given to be 10%. So 5th year contribution will be paid in the 5th year. So no discounting rate. 4th year will be paid in 5th year. So one year. 3rd year will be paid in 5th year. So 2 years discounting. 2nd in 5th. So 3 years. 1st in 5th, so 4 years discounting. So 1,31,080 into 0.683, 89,529. That becomes your opening obligation. Unwind the discount. Then 131 into 0.7513, 98,482. Add this and so on and so forth. The obligation will be built up to 6,55,398. So ये हो गया original plan. This is original plan. No change. This is the original plan. Okay, as per original assumptions, 1%. So what is the entry that you are going to pass? Employee benefit expense account debit, finance cost, that is employee benefit expense account debit to provision for employee benefits. So 89,529 first year, 98,482 second year, 1,08,000 third year, so on and so forth. Okay. Interest expense is 0 for the first year, 8,953 for the second year, 19,696 for the third year, so on and so forth. Credit the liabilities. Okay. Is it okay till now? Have you understood till now? Yes, Rashmi? See, if I had to do the physical solving of these questions, we would have a lot of time that would be lost. I could not be able to complete the standard in that case. Okay, so that is why I am taking this in this particular way. Okay, it's basically mathematical. You should be in a position to do that. Have you understood this? Yes, so far have you understood? Yes, all right. आगे बढ़ते हैं. Now what is happening is, now the thing is, your assumptions are changed. Not assumptions, your plan is changing from 1% to 2.5%. From 1% to 2.5%. Discuss the impact of this change if the benefit was revised at the end of year 2. देखेंगे. So, revised at the end of year 2. Okay, so salary in year 1 crore, increase at 7%, 1 crore 31 lakhs. Cost of benefit on termination is 16,38,495, which is essentially 131 into 2.5% into 5 years. So this is become my revised. Pehle kitna tha? It was 6,55,000. Now it has become how much? 16,38,000. Basically, if you see, it is nothing but 655, 398, 2.5 times of this. Okay, it is nothing but 2.5 times of this. So this is the change that has happened. Now let us proceed to attribute it. So 16,38,000 by 5, 1, 2, 3, 4, 5. So this is attributing to the periods of service revised. Measurement. Now I have to do the measurement. So therefore, I will do the reverse discounting same way was present value, first year discounting, second year, third year, fourth year, and then you multiply the discounting factors. 3,27,000 into the discounting factor. So that gives you the current service cost, which is the opening based on which the finance cost is recorded. So your expense, your obligation is getting built up. Your organization, your obligation is getting built up. Okay. So now the change is happening in the second year. So second year, your closing obligation is 4,92,000 under the revised assumption. And in the first case, it was how much? It was 1,96,964. So if I take 492,410 minus 196,964. If I take this, it comes to 2,95,446. So in year 2, my liability increased by 2,95,446. So now, if I have to look at the impact, if I have to look at how exactly the accounting has to happen, it is going to happen something like this. First year, this is obviously based on original. अरे मेरे को सपना थोड़ी आएगा. I won't get a dream that I will change it in the second year, है ना? So first year is going to be based on original. Expense account debit 89,529. Don't look at this. This won't come for the first year. First year is based on this 89,529. To provision for employee benefits 89,529. Okay. So that is the first year entry. Second year, your obligation is 98,482. Correct, sir? So 98,482. Then you are going to recognize the expenses of on account of interest 8953. Then in year 2, what is happening is your plan is getting changed. Why is the plan changed? Because 1% rate is changing to 2.5%. Is it actual assumption? No, it is a past service cost. So you will debit the past service cost with 2,95,446 and credit 4,02,881 as provision for employee benefits. In the third year onwards, you will do the accounting as per the revised plan. So expense, you can see 297, 327. So in the third year onwards, you will do the accounting based on the revised plan. Is the impact of modification or plan amendment or past service cost clear? Yes. Is it clear? Everyone, please respond. Saksham, Rashmi, Kaushiki, Shailendra, Sanjay. Yes. Ai baat samajh mein? Did you understand? Yes. Kaushiki has confirmed. What about the others? So what I want you to do is pen paper uthaiye and do these questions once again after the topic is done. Do these questions, because what happens when I teach here, it appears to be very simple, but when you actually sit to do the problems, you will face difficulties such as presentation difficulty. Aapko concept pata hai, but how to actually present it may create a problem. So I want you to try these questions out by yourself. Okay. So that takes care of the first part. Second, the revision happens at the end of year 5. So year 1, 2, 3, 4, you will do the accounting for this. Mere ko sapna thodi aayega. I'll not get a dream. So all these will be based on original assumptions. All this will be based on original assumptions. So you can see 89, 98, 1,08,000, 1,19,000. We have taken the same 89, 98, 1 lakh 8, 1 lakh 19 and 131,080 is what we have accounted. So I have recorded all these expenses based on the original plan, Okay. Next, your interest also you will record based on the original plan. What is the impact of changeover? Well, my new liability is 1638,495, whereas the old liability was 655,398. 655,398. 6,55,398. Okay, so that gives you how much? That gives you 9,83,097. That gives you 9,83,097. Okay, so that impact is recognized as a past service cost. In year 5, which is going to hit what? Which is going to hit the P&L. All clear? Yes. Is it okay? Yes or no? Okay, so that takes care of that example. Yes. So we have done question number 10. Acha, coincidentally, this question is also there in your study mat, the first part. Only thing what is the difference is, I think there is all the figures are like it's 1 crore in our example. There, I think it is 1 lakh. Okay, so your answer will basically be short of 2 decimals or 3 figures. Okay, so that is the only change there. Okay, so you can refer that. Then this is the additional part which I have introduced. This is the additional part for us to understand. Okay. All right. So that takes care of change in your plan change, which gave rise to increase past service cost. Okay. Gains and losses on settlement. Okay, gains and losses on settlement, you will have to recognize. Gains or losses. Settlement means what? You settle all the obligations, you pay all the benefits as per the plan, okay, included in the actuarial assumptions. So that is known as settlement. So gain or loss on settlement is nothing but present value of obligations being settled compared to what is the settlement price. Okay, so that is your gain or loss on settlement. Okay, so that is how you do the calculations. Okay, coming to the ultimate cost of benefit, we have discussed this. Okay, you do a discounting, which discount rate you use, for special cases what rate to use. Okay, nature of discount rate reflects time value of money, does not reflect actuarial risk, etc., etc. Okay, so all these things is theory. You can refer to it. It's what we have already discussed. Okay, it's what we have already discussed. Now there are cases where your defined benefit obligation, DBO, which we have discussed so far, can be categorized into 2 types. It is backed by an asset. So asset backed. It is backed by assets. Or the other one is non-asset backed. Means what? Non-asset backed means you just go on recording the obligation. See, look at the entries which we had passed. Look at the entries. Expense account debit in all the cases. Credit the liabilities. Is there any cash flow recorded here? No. It is a mere entry that is recorded for accruing the liability. Which brings us to the issue, sir, cash flow to kidhar bhi nahi hai. There is no cash flow anywhere. Okay, so that is one way of recording. Okay, non-funded. That means provision is made as discussed, which are basically non-cash provisions. Cash is not set aside. So what is the risk? That cash may not be available at the time of settlement of the defined obligations. So this is non-funded. Ind AS 19 does not mandate you to create a separate fund and invest that. वो बोलता नहीं है. Ind AS 19 tells if you have an asset backed fund, accounting for that asset backed fund also should happen as per Ind AS 19. But यदि आपके पास funded नहीं है, no problem. Calculate the obligation in line with Ind AS 19. Calculate the obligations in line with the concepts laid down in Ind AS 19. Acha, can I have funded with asset backing? Of course you can. Of course you can. Okay. So provision you make as discussed, then you set aside the cash and invest. Sir, where to invest? Again, Ind AS 19 does not tell anything. But your intention here is not to invest to make profit. Your intention is to ensure that cash is there. Your intention is to ensure that you are having cash or near cash instruments to convert it into cash when employees retire or when the employees resign. Okay, so intention is to make sure cash is available when the liability is due. And if you remember, you would have studied debenture redemption reserve and debenture redemption fund. So this is somewhat similar to that concept. This is somewhat similar to that concept. So there are two modes of investments. One is you create a separate entity. एक fund बना दो. Investments are held by that entity and these investments are used solely for purpose or funding of the employee benefits. So ये हो गया one method. Second method, you take a qualifying insurance policy issued by an unrelated party. Proceeds are to be used solely for payment or funding of employee benefits under the defined benefit plans. Okay, so this is how you will have your plan assets. This is how you will have your plan assets. Is it okay? Are you somewhat clear about asset backed benefit obligations? Yes. Somewhat clear? Yes. Two modes. One is you have your own trust. Put the money in that trust. Trust will buy the investment. Investment will income will come to the trust, and ultimately it is going to go in working of your what you can say in settling the obligations. So that is how you will do the recording. Coming to the next part, you could alternatively take an insurance policy. You could alternatively take an insurance policy. Is it okay? Yes, all clear. So far, is it clear? How to do the accounting for the asset is now what we are going to discuss. Okay. So that investment is what is known as plan assets. That investment is what is known as plan assets. Is it mandatory to have plan assets? Answer is no. Ind AS 19 does not mandate. It is abundant caution. Acha, if I have plan assets, should I invest in fixed deposits only? Again, no. Where you want to invest, how much you want to invest, whether you want to invest, all these are not decided by Ind AS 19. But if you have invested what you wanted to invest to ensure you don't have cash shortfall in the future, the amount you have invested will be regarded as a plan asset under Ind AS 19, the accounting of which has to be done accordingly. Is it okay? Yes. Clear? Clear? Tell me, is it clear? Okay, fine. So now coming to the concept of plan assets, we have some small questions. So from the following, compute the actual return on plan assets in respect of Vinayak Limited for the year ending 31st March 2020. Benefits paid is given, employer's contribution is given, year-end balance is given, opening balance is given. Is this even what I will say? This is this is an insult to your intelligence. Okay, but question hai, so we will have to do that. Okay, so opening balance 20 lakhs, closing balance 28 lakh 50, employer's contribution 7 lakhs. You have paid benefits worth 5 lakhs. So the balancing figure is your return on plan assets. The balancing figure is your return on plan assets. Alternatively, you can present it in a statement form. Okay. So statement is closing balance less contribution, add benefits paid, less fair market value. So that gives you 6,50,000 actual return on plan assets. Actual return on plan assets. Is it okay? I don't want to invest much time in this because that is too elementary. Okay, so ye ho gaya. All right. Then how do you present? How do you present? Okay. You have a defined benefit obligation. Against that obligation, you are having plan assets. You are having plan assets. Tell me one thing. And now don't forget this slide. Tell me one thing. I am having an obligation and I am having assets to meet those obligations. Now you tell me, are these assets freely available? Are these assets freely available to meet any obligation, or are these assets available only for meeting this specific obligation? Are these assets, these plan assets, these investments available to meet any obligation? Tomorrow, suppose you get a tax demand. Can I sell these assets and pay off the tax demand? Or are these assets exclusive for the employee obligation? Answer is it is exclusive, it is specific. So what the standard tells us, you will have to net it off. You will have to net it off. You cannot have obligation on one side, investment on the other side. The reader of financial statements will get confused. So what you have to do is you will have to net it off. So employee obligation minus assets. If obligation is higher, it is a deficit. If assets are higher, it is a surplus. Okay. If obligations are higher, it is a deficit. If assets are higher, it is a surplus, which is what is mentioned in the notes. So you will have a deficit or surplus, which is basically present value of defined obligation minus the fair value of plan assets. The fair value of plan assets. Plan assets could be in the form of benefit fund, or it could also be qualifying insurance policies. It could also be qualified insurance policies. Okay. And what is present value of defined obligations? Well, we have done that question. No, it is present value without deducting plan assets of expected future payments to settle the obligation from employee service in the current and prior periods. So this is how you will do the accounting. Okay. The final presentation. Deficit is a net defined benefit liability. Surplus is nothing but an asset. Surplus is nothing but an asset. Is it okay? Yes. All right. Okay. Suppose your entity has more than one defined benefit plan. Separately apply these procedures. The standard encourages to use a qualified actuary. AS 15 did not do that. But here it is saying that it's better that you use an actuary. Actuary is the person who gives all this data. Mera investment is how much, what is my liability balance, everything is what the actuary gives. Okay. Para 59, valuation to be done before the end of the reporting period. Valuation to be done before the end of the reporting period. Results are updated up to the end of the reporting period. Okay. So estimates, averages, simplified computations may provide reliable approximation. Account for legal as well as constructive obligations. We have discussed all of them. Okay. Now, if present value of the defined benefit obligation minus the fair value of plan assets, if it is positive, positive means what? Obligation greater than assets. Obligation greater than assets. Then we call it as a deficit. If it is a deficit, it becomes a net defined benefit liability or net defined benefit obligation. Entire deficit is recognized in the balance sheet. It is a provision under the head non-current liabilities. Under the head non-current liabilities. Is it okay? Yes. Is it fine? Have you understood this part? Yes. Have you understood this part? Yes. ये बात समझ में आ गया? Positive? Yes. Then I'll come to the next part if it is negative. Okay. Coming to the next part, if it is negative, that is asset is greater than obligation. Asset is greater than obligation. Okay. If it is negative, we call it as a surplus. We call it as a surplus. It becomes a net defined benefit asset. It becomes a net defined benefit asset. And we will recognize it in the balance sheet. We will recognize it in the balance sheet, but there is a cap. There is a cap. It will be recognized at the least of the surplus computed above. Okay, this. जो भी figure है, suppose we call it X. Surplus computed above is X. And asset ceiling. Asset ceiling determined using the discount rate specified in para 83. Let us call it as Y. So the surplus which you recognize in the balance sheet will be the lower of X or Y. Will be the lower of X or Y. What do you mean by asset ceiling? Asset ceiling is nothing but the present value of any economic benefits available in the form of refunds from the plan or reduction in future contributions to the plan. So asset ceiling is nothing but present value of economic benefits available in the form of refunds or reductions in future contributions to the plan. इसको हम लोग बोलते हैं asset ceiling. See, ultimately understand one thing. My asset, you have studied, okay, let me correlate. Have you guys studied Ind AS 36 impairment? Have you studied Ind AS 36 impairment? Yes. Have you studied Ind AS 36 impairment? Yes. All right. So wait, nobody confirmed. Have you studied impairment? बताओ यार, impairment पढ़ा है क्या आप लोगों ने? Yes. Okay. So if you guys have studied impairment, then at that point of time, you would be aware that I have to recognize my asset at the recoverable value. Okay. Carrying amount or recoverable value, whichever is less. That was the principle of impairment, if I'm using the terms correctly. Recoverable amount was higher of value in use or fair value, less cost to sell. And if your carrying amount was higher, recoverable amount was lower, the difference would be represent an impairment loss, which would be taken to the profit and loss account. So this was the meaning of, this was what you used to do. Why did I have impairment? Because any accounting standard should give reliable information. So your asset has a lower realizable value in the market, lower recoverable amount, then I have to show that fact in my balance sheet. I have to show that fact in my balance sheet. Recoverable amount is basically higher of value in use. Value in use is present value of future cash flows derived from the asset, or fair value less cost to sell. So that is essentially what the asset is worth in the market today. उससे मेरा कितना फायदा हो रहा है, that is the recoverable amount. That is the value that you will use, that you have to present in the balance sheet for the assets. That is the value you have to use to present to the assets. Coming to the same concept here, you have made investments. You have made investments. These investments are made to generate economic benefits in the future. Now, the present value of those economic benefits, which could be in two forms, either refund from the plan. You have contributed more, but the obligation was less. So now you are allowed to draw a refund from the plan. The entity is allowed to take a refund from the plan. This is the first one. This is an economic benefit to you. Second one is, you will not get a refund, but what you used to contribute, that amount substantially goes down. That amount ends up going down. So if there is this refund of the plan or reduction in contribution, the present value of that represents nothing but the economic benefit of those plan assets. Yes, so you are going to limit the surplus that you recognize to the present value of plan benefits. Is it okay? Yes. Are you able to now correlate this to that Ind AS 36 which you had studied? Yes. Ultimately, I have to recognize an asset at its recoverable amount. In this case, the recoverable amount is present value of economic benefits available. It could be either in the form of refunds, or it could be in the form of reductions in future contribution. Is it understood? Yes. Have you understood? Yes. Any example of refund or reduction? It'll come. Okay, it'll come. Net defined benefit asset under plan A, net defined benefit liability under plan B. Can you offset it? Can you offset it? You're having two obligations, two plans. So can you offset? You follow the principles of Ind AS 32, which you've already studied. That is, set off is permitted if and only if legally enforceable right is available to settle the obligations of plan B. Settle the obligations of plan B using surplus of plan A, intends to settle on net basis or realize the surplus in plan A and settle the obligation under plan B simultaneously. Settle the obligation under plan B simultaneously. So that is the offsetting criteria you had studied in Ind AS 32. If same criteria exists, you can net off different plans, asset and liabilities. Okay. Does refund imply insurance receipt? Answer is could be. Okay. That means when I say insurance receipt, it is basically not the premium, but the excess assets which are there with that insurance company may be refunded back to you because you don't have those many obligations in the first place. Okay. So it's not insurance receipt, but it is a refund of the plan benefits, refund of the plan assets, not the benefits, refund of the plan assets. That plan is known as an insurance plan. That's it. That plan is known as an insurance plan. Is it okay? Have you understood? All right. So this is, did you understand the concept of asset ceiling? Rashmi, Shailendra, Saksham, Sanjay, Kaushiki. Did you understand the concept of asset ceiling? Did you understand the concept of asset ceiling? Yes, Soham is not there to be seen. Did you understand the concept of asset ceiling? Bolo yaar. Okay. Kaushiki confirmed. What about Rashmi? Did you understand? Shailendra, did you follow? Okay, fine. All right. So now let us proceed to certain small illustrations. Okay. Certain small illustrations and then some questions. Okay. All right. Fine. Okay. How will the following information be presented in the balance sheet of Udyog Limited? Okay. So you are given present value of defined benefit obligations 3,500, fair value of plan assets 3,332. बताओ भाई कैसे प्रेजेंट करोगे? 2 लाइन का आंसर है, बोलो सब. What, how will you present it? Deficit is 168. Deficit is 168. Okay. Where are you going to show this? This you are going to show it under long-term provisions. This you are going to show it under long-term provisions. Okay. This is your net defined benefit obligation or net defined benefit liability. Okay. Coming to the next one. Okay. So asset is 2975 and this is 2750. So this gives you 225. Asset ceiling is 175. So what are you going to present? Well, I will be presenting it as 175. Yes, this is what I will present. Lower of the deficit 168. Provisions. Yes, that is okay. That is right, Rashmi. Okay. So 175 will be presented under the heading investments. 175 will be presented under the heading investments. Okay. All right, fine. So ye do ho gaye. Okay. So we completed step number 2, recognition in the balance sheet. Okay. In all, we had how many steps? We had in all 4 steps. Okay. If you look at the the initial discussion, we had in all 4 steps. Determine deficit or surplus, that is done. Recognition in the balance sheet, that is also done. Recognition in the P&L is what we are doing now. And remeasurements to OCI is the last part. Okay. So now we come to recognition in P&L. Recognition in P&L. What do we recognize? First one, service cost. We have done this. Current service cost, I have shown you. Past service cost, I have shown you. Gain or loss on settlement. Past service cost could arise due to plan amendment. In our example, 1% became 2.5%. Curtailment. All these things you will have to show it in the profit and loss. You will have to show it in the profit or loss. Net interest on the net defined benefit liability or asset. This is the change during the period in the net benefit liability or asset that arises from passage on. We call it as net interest. Why? Because interest on defined benefit obligation we have computed. I showed you. It is similar to unwinding of discount. Are, do you recollect? We have done this. First year opening obligation into 10%. Second year opening obligation into 10%. Like that, I would end up unwinding the discount. So this is going to be an expense. This is going to be an expense. At the same time, you have put your money in, plan assets. Those plan assets are going to give you an income. That is interest earned on plan assets. That is interest earned on plan assets. So the net change the net interest is nothing but the expense minus the income. This also will be recorded in the profit and loss account. This is also going to be recorded in the profit and loss. Remeasurement of the net defined benefit liability with actuarial gains and losses, return on plan assets, any change in effects of asset ceiling, these will be recognized in other comprehensive income without a reclassification to P&L. Without a reclassification to P&L. Okay. When you talk about any change in the effects of asset ceiling and return on planned assets, exclude the amounts which are included in the net interest calculation, because that is already hitting the P&L. So other than that, if there is any change in the return or effect of asset ceiling, you will recognize it in the other comprehensive income without a reclassification to the P&L, without reclassification to the P&L. Okay, so that is fairly simple. Yes, what goes where, recognition in the P&L. Net interest. How do I recognize? Opening balance into the discount rate. Simple enough, on the net defined benefit obligation. But in our examples, typically we have done it on the gross amount of asset, gross amount of liability. Ultimately, it comes up to the same thing. On remeasurement, you will calculate up to the date of remeasurement based on opening balances. For the remainder, calculate on the remeasured balance of net defined benefit obligation or asset and the discount rate used for remeasurement. Okay, so net interest is interest cost on defined benefit obligation, interest income on plan assets, interest on the effect of asset ceiling. Okay, so ये है, this is just theory, this is just for your knowledge. ये एग्जाम में तो ऐसे आया नहीं है. Okay, it's not come, it's a lot of theory. Okay, the questions which we are doing more exam oriented. Okay, so that takes care. Then recognition in the profit and loss, return on plan assets you recognize, and remeasurement of net defined benefit liability or asset, we have shown what will go, what will not go. Okay, so plan amendment, plan curtailment, plan settlement, all these things are discussed here. Just go through this for homework. It's just theory. Okay, nothing specific to discuss. Okay, coming to a full-fledged question on what we have studied so far, Okay, mark this question as extremely important. It is similar to illustration 24 on page 9.55, if I'm not wrong. 9.55. Yes. Yeah, 9.55, 56. Okay. Extremely important question. You will have to see this question the way we are solving it, because this is more of an exam oriented question that you could expect. Okay, so let us start. I have the question in this sheet with me. You can have a look at how we are going to solve it. Okay, Bharat Power Limited is a company with a turnover of 27,500 crores. That's irrelevant. Having a large employee base. The company has provided a defined benefit plan to its employees. The following information pertains to the balance of the funds, assets, and liabilities for the financial year 2019-20. What are you given? You are given present value of defined benefit obligation opening as well as closing. You are also given fair value of plan assets opening as well as closing. For the financial year 1920, the service cost was 1.65 crore. Service cost means what? It is increasing the obligation. Employees have provided service for an obligation to get in the future. So therefore it increases the obligation. The company made a contribution of 3.33 crores. Made a contribution means you are increasing the assets. Assets will go up. No benefits were paid during the year. That means nobody retired, nobody resigned, nobody left, nobody died, nothing happened. So no benefits were paid. Consider a discount rate of 8%. you are required to compute the balances to be included in the balance sheet, amounts to be recognized in the statement of P&L, and other comprehensive income for 2019-20. Also give the journal entries in respect of amounts to be recognized. Just go through this question quickly, 2 minutes. Done? Yes. So now let us first do it the long way. Then we will look at the net presentation. Okay. Let us do it the long way, because in the long way, the chances of us making a mistake are very less. Okay. So plan assets, opening balance 3,420. 1 second, please. ये तो कुछ ज्यादा ही मोटा हो गया. Okay, 3,420. So that is the opening balance. To balance brought forward 3,420. Coming to the next, closing balance is given 3,825. Balance given 3,825. Okay. Have you paid anything? Answer is no. They have given here. No benefits were paid during the year. So by benefits paid out, outflow out of plan assets is 0. You are given employer's contribution for the period. So contribution kitna hai? 3.33 crores. So plan assets increase to employer's contribution 333. Okay. Now if you total it up, this gives us a balancing figure of 72. This gives us a balancing figure of 72. What is the 72? This is the actual return on plan assets. This is my actual return on plan assets. Is it okay? Have you understood this part now? This is a balancing figure. Have you understood this? Yes. The same thing is presented in a statement form. Closing fair value 3,825 minus 3,333, add benefits paid 0, less opening fair value 3,420. So that gives you actual return 72. That gives you actual return 72. Same thing, no change at all. Okay. Now let us come to the obligation. Opening obligation 4,200, closing is 4,740. Opening 4,200, closing 4,740. So that is given. Next, you are given current service cost. Current service cost means employee is providing service which is increasing his entitlement to the obligation in the future. So that increases the obligation 6,165. Then consider a discount rate of 8%. So you will have to increase, your asset. You will have to, increase the liability. It is the unwinding of the discount. So 4,200 opening obligation multiplied by 8%, So that gives rise to 336. And finally, when you balance this, you get a balancing figure, which is your actuarial loss. Why actuarial loss? It's increasing the obligation. It is increasing the obligation. मैंने तो plan, I have considered the interest impact also. Even after that, the obligation had a shortfall. Had a balancing figure. So that is nothing but actuarial gain or actuarial loss. In this case, it is an actuarial loss because It is an increase in the benefit obligation. It is an increase in the defined benefit obligation due to change in actuarial assumptions. There is no other case why this amount will increase. Okay, so this gives you 39. Now the question is, sir, how do we present in the profit and how do we, what do we recognize in the P&L? What do we recognize in the P&L? Okay, and the balance sheet. See, academically you can do this separate. इससे आसान होता है काम. But the final presentation should be on a net basis. So we start the net basis. Opening liability 4,200 minus 3,420. So 4,200 minus 3,420, 780. This is the opening liability. What is the net interest expense? Net interest expense. See, your net deficit is 780, right? Net deficit is 780. 780 into 8%. 780 into 8%. Rounding it off, we get 62. So this is the net interest expense. Sir, why expense? Because I have a net obligation. Obligation means my interest will be an expense only. Okay. Closing net liability. Very simple. 4,740 minus 3825. Minus 3825. So 4,740, 3825, 915. 915. Okay. Is it fine? So far, is it okay? Yes. So far, is it okay? Net increase in liability. Closing liability 915. Opening liability 780. So increase in liability is 135. Increase in liability 135. Is it okay? अरे बोलो, so far चीजें समझ में आ गई? Okay, net interest you did not understand. Okay, I will come to that. बाकी चीजें समझ में आ गई? Did you understand the remaining things? Rashmi, Shailendra, Saksham, Sanjay, Soham, if you are there. Okay. All right. So now let us proceed to understand two things. One is, look at this. This is your actual return on plan assets. This is your actual return on plan assets. Okay, balancing figure. Now see, plan assets has two sources of return. One is interest. Interest is on opening balance. Is on opening balance. The other source of interest is actuarial gain or loss on whatever remeasurement bolo, kuch bhi bolo. Okay, actuarial gain or loss. In our example, opening balance is 3,420. Rate of interest kitna hai? Rate of interest is 8% discount rate. Okay, so 3,420 into 8%. That gives you how much? 3,420 into 0.08. 274. 274. I'm rounding it off. Okay. Actual return. Actual return was how much? 72. Actual return was 72. That means what? See, you have earned interest of 274, but your actual return is only 72. That means what? Actuarial gain or loss is 202. Have you understood this? Have you understood this? Are bolo yes or no? Did you understand how did we get the actuarial gain or loss on remeasurement? Yes, 202 is my ultimate actuarial loss. Is it okay? Yes. Kaushiki, did you follow 202? See, my assets have earned how much? Did you understand 72? Yes. Okay. Tell me, did you understand 72? It is a balancing figure. It is a balancing figure. If you take out the plan assets register, if you take out the plan assets register, you will look at opening balance. This is actual. आपके पास 3,420 lakhs के investments थे at the beginning of the year. Number one. Second, if you open the bank statement, you will see that a payment of 333 lakhs is made towards plan assets. You look in the plan asset register, you will see investments addition of 333. So this also should be clear. So 3,420 is clear, 333 is clear. Closing balance, you can check. Closing balance, you can check 3,825 from the investment register. कहां पे कितना पैसा डाला है, उसका करंट वैल्यू कितना है, all of that is there, 3,825. By benefits paid out of plan assets, I have not paid anything. So therefore that is zero. Okay. So all these are actuals. What I want to say is all these are actuals. So therefore, my actual return is 72. Matlab, if I compare opening plus contributions minus closing, net dikh raha hai that 72 is the increase. The net 72 increase is purely visible. Coming to the next part. Sir, yes, 72 is not the complete picture. 72 is not the complete picture. Why? Because on the opening asset, there will be some interest which you are going to earn. Yes or no? See, you just cannot say 72 is my net income. इससे बात नहीं बनता है, because your plan assets income is coming from two sources. One is interest, the other is actuarial gain or loss. So coming to my actual return, this is the 72 which was a balancing figure. 72 which was a balancing figure. The opening balance is 3,420. I have not paid anything. Matlab 3,420 was invested for the entire year. 3,420 was invested for the entire year. That means at 8% rate, the interest on this asset you would have earned is 274. Sir, what is this 8%? This 8% is the discount rate. This 8% is the discount rate. But sir, discount rate is only for the obligation. No, it has to be considered for the net obligation. Net obligation is after adjusting the plan asset. That means this 8% is also the income generated by this plan asset, 274. But sir, my actual return is only 72. आप कह रहे हो कि I have earned 274. So where is the balancing figure? 274 is interest earned, notional, जो आप calculate करके बता रहे हो. You are deriving it. 72 is what is visible from my asset register. 72 तो दिख रहा है हमको. So therefore, where the balance has gone, that balance is sitting as a loss of 202. It is a balancing figure. This is nothing but 72 minus 274. This is nothing but 72 minus 274. 202 is nothing but an actuarial loss rahega isme. It is an actuarial loss which has to be recognized, where this will go in other comprehensive income without a reclass to the P&L. So coming back to my example, actual return on plan assets 72 minus the interest 274. So you are having actuarial loss of 202. So what is your net remeasurement? The loss of 202 plus ye jo loss hai 39. So 241 is your final actuarial loss. 202 plus 230 plus 39. 202 plus 39. Okay. So that gives you 241. So now what is the journal entry that you will pass? Simple hai, no problem, very easy to understand. Okay. First one is you are paying cash. So 333 to cash. This is which cash, sir? This is ye wala cash, 333, which is increasing the asset. You are increasing the liability, of course. Opening liability was 780. Closing liability is 915. So increase in liability is 135, which is the increase in the liability. You have an actuarial loss of 241, which is recorded as a loss. And finally, you are having a profit and loss impact. Which is current service cost 165 plus the net interest of 62. 227. Sir, how did you get net interest of 62? Very simple. Opening balance of asset minus opening balance of obligation. Obligation is higher, so it gives rise to net interest cost 62. So 227. So this is what is the journal entry that you are going to pass. How will these amounts be recognized? Simple. Profit and loss 227 will go, 165 plus 62. Other comprehensive income 241. So total comprehensive income will be 468. Extract of balance sheet, you will have a closing net liability of 915. You will have a closing net liability of 915. Is it okay? Yes. Did you understand? Everyone understood the question? Yes, and the corresponding answer. देखो कोई भी डाउट है आराम से पूछो. Please feel free to ask. Today Sumit Jain is not there. Aniket Jain is not there. Saksham, did you follow? Kaushiki confirmed. Rashmi, did you follow? Shailendra, बात समझ में आई क्या आपको? Yes, did you guys follow? Yes. Rashmi. It is a little complex, but when you split it up, it gets simplified. Okay. So what I want you to do is, I need you to try this question by yourself. Okay. You could do one more thing. See, study module na. Study module mein I'll show you the question. This is the question. Okay. RKA Private Limited. I want you to do this for homework. And when you do this for homework, please do it without looking at the answer. Question देखते ही आपको समझ में आ गया रहेगा. It is exactly the same what we have done. Old company, एनुअल टर्नओवर सब कुछ वही दिया है, फिगर्स आर चेंज्ड, लार्ज एम्प्लॉय बेस, ओपनिंग बैलेंस ऑफ ऑब्लिगेशन, फेयर वैल्यू ऑफ प्लान एसेट्स, service cost was 55 lakhs, contribution of 111 lakhs, no benefits were paid during the year, consider a discount rate of 8%. So I want you to try this question. I want you to try this question. Okay. All right. Please try it out. You should be in a position to get this without referring the answer. Without referring the answer. Okay. Without referring the answer. Once that is done, you are all set. The standard is almost coming to a close. Okay. ये एक चीज important था. We did this. You want a break or you want to continue? You want a break or you want to continue? You want a break or you want to continue? Okay. ठीक है. We take a 5-minute break. It's 9:10. We meet at 9:15. Class may get extended slightly so that I can complete the standard in totality. Okay. But वो ज्यादा नहीं होगा. Okay. It should be doable. Okay. So Nisarg, we take a 5-minute break. We meet at 9:15. Okay. All right. So welcome back. I think there is a slight issue with the video, but it should be fine. Okay. All right. So let us start the next part, remeasurement to OCI. So we had in all 4 steps. First step was determining the ultimate cost of benefit. The second step was presentation in the balance sheet. The third step was amounts taken to the profit and loss. And the fourth step is your amounts taken to the OCI. So OCI, you will be recording change in the effect of asset ceiling and actuarial gains or losses. Okay. Unexpected fluctuation of employee turnover, changes to assumptions, changes in estimates of future turnover, changes in account discount rates. These are only examples. These are only examples. Okay. We saw actuarial assumptions which were relating to demographic assumptions or financial assumptions. When there is any change in those assumptions, it will impact my obligation workings, and that is why that impact will have to be taken to other comprehensive income. Okay, so total return on plan assets minus net interest on net defined benefit liability. See, this is based on discount rate. This is based on discount rate. In our example that we just now did, this figure based on the discount rate was 62. This figure based on the discount rate was 62. The total return on plan assets, was how much? The total return was, 1 second. Give me a minute. Total return on plan assets was 72 this side, and net interest on net. Okay, fine. Give me one thing. Total return on plan assets remeasurement. We had a remeasurement of 241, right? We had a remeasurement of 241. So if I will have to split that, I should be getting 74 minus 62. Second. That is, yeah, 274 remeasurement less interest on 3,420 at 274. Okay. Based on discount rate, net interest. This was an expense, right? This was an expense on net defined benefit liability. So just give me a minute. Just a minute. Let me check. T03 which is basically 274. Nahi, not this. Interest cost 336 I have considered. Measurement 39. Actuarial. 1 second. Return on plan assets. Total return 74. 1 second. In notes 72 bifurcation is given. Yeah, that 72 bifurcation. Yes, remeasurement is there, 202, 72 and 274. Fine, I think that is the only one which is there. Okay, all right. So if you take that remeasurement 202, 274 and 72, actual return on plan assets minus net interest 274. Yes, this is the only way. 202. So this return on plan assets is on account of remeasurement. Okay. So this goes in OCI. This goes in OCI. This also goes in your OCI. Okay. So that is done. That takes you to your other comprehensive income. So now we just pull up the last question of Ratna Limited. It's the same question that we had seen earlier. Pays a lump sum benefit on termination of service. The salary is 1 crore, assumed to increase at 7%. Discount rate used is 10%. Show the buildup of the obligation. During the second year, the last drawn salary of the employee is expected to be 1 crore 50 lakhs. What will be the impact of this change? So now in this case, what has happened is, in the initial case, we had done a similar question, but 1% had become 2.5%. This is not an assumption. This is a factual change. You've actually made a change to the plan to which the employee also is a party to it. And therefore, this has to go to the P&L. However, in this case, what is happening is your last drawn salary is expected to be 1 crore 50 lakhs. If you look at the question, changes change in estimates or of increase in salaries, so that becomes an actuarial gain or loss. So let us look at the impact of this in the solution. Okay, so we had this initial impact. It is the same like the last one. No change in this. Okay, so 89,529 debit, interest to provision for employee benefits. So exactly the same. There is no change in this. This part is the same as the earlier one. Now there is a revised assumption. Salary in year 1, 1 crore. Salary assumed at the end of year 5 is 1 crore 50 lakhs. पहले कितना था? 1 crore 31 lakhs. So now the salary has increased by 1 crore 50 lakhs. So cost of benefit on the termination, 1.5 crores into 1% into 5 years, it comes to 7,50,000. आपका पहले कितना था? 6,55,398. Now it has come to 7,50,000. So let us attribute the benefit revised. So this is 1,50,000 each year. Then you do the working, you are going to get the fresh liabilities at the end of years 1, 2, 3, 4, and 5. So now the change happens year 2 onwards. So year 2, your new liability is 225,394 versus what was the old liability? 2,62,150. Sorry, 1,96,964 present value, 196,954. So this is giving an increase in liability of 28,430. So year 1, obviously I don't know that the estimate will change in year 2. So year 1 would have happened on the basis of original amounts. Year 2, benefits recognized on original amount, interest recognized on original. The impact is taken to the other comprehensive income, debit OCI, which is an actuarial loss, 28,430. And with effect from years 3, 4, and 5, what are you going to do is you will do the accounting based on the revised workings, okay, 37, 22, 54, based on the revised workings. So this is a change in the future salary. This change is based on an assumption. It is an actuarial assumption. So the impact of such change where it is taken, this impact is taken to the other comprehensive income and not to the profit and loss. Is it understood? Yes. Have you understood this part? Have you understood? All clear? Kaushiki, Rashmi? Yes. All clear? Bolo. It's the same repetitive question, only the calculation has changed in the last part. Once you are understood, please let me know. All right. So it's clear. Rashmi has confirmed. What about the others? Shailendra, Saksham, Sanjay, Kaushiki. Yes. Clear, Kaushiki? Please confirm. Shailendra has confirmed. I need one or two more confirmations before I proceed. If you are checking the workings, please have a look. The first part is the same as was already done. Okay, fine. All right. You can have a look. If at all there is any difficulty, you can reach out to me. No problem. Okay. So this takes care of question 13. It's quite simple. It's basically what we have already done. Okay. So that takes care of actuarial assumptions. Okay. Now coming to the next part, okay, is the way in which the increase is calculated. Okay. The return on plan assets is calculated. This question has been asked in your RTP once. Okay. How the return is going to be calculated. At 1st April 2019, the fair value of the plan assets was 10 lakhs. The plan paid benefits of 1 lakh 90 and received contributions of 4 lakh 90 on 30th September 2019. The company computes the fair value of plan assets to be 15 lakhs on 31st March 2020. The present value of the defined benefit obligation to amount to 14,79,200 on the same date. Actuarial losses on the obligation were rupees 6,000. At 1st April, the company made the following estimates based on the market prices at that date. Interest and dividend income after tax payable by the fund is 9.25%. Add realized and unrealized gain on plan assets after tax is 2%. Administrative cost minus 1%. So expected rate of return is 10.25%. Determine the actual return and the expected return and also compute the amount to be recognized in other comprehensive income. Recognize the amount to be transferred to other comprehensive income. Okay. So one thing, let us just start working. First is the actual return. Okay. Opening balance 10 lakhs. Opening balance 10 lakhs. So here I am having opening balance 10 lakhs. Balance brought forward. Next. This is 10 lakhs. Then I am having payment of benefits 1 lakh 90, receipt of contribution 4 lakh 90. Okay. So employer's contribution increasing. So 4 lakh 90. Benefits paid, which is an outflow, credit 1 lakh 90,000. Okay. So both increase and decrease we have given effect to. Closing fair value is 15 lakhs. So closing fair value is 15 lakhs. Balance carried down 15 lakhs. So therefore, the surplus, that is the balancing figure, this is nothing but actual return on plan assets. This is nothing but actual return on plan assets. Is it okay? Yes. Is it fine? Is it clear so far? So this is nothing but in a statement form. If I present it, it will look something like this. Can you give me a go ahead? Can you give me a go ahead? Yes. Shall we proceed further? All right. Now, see, the question should specify this is what I feel, but since contributions are happening during the year, in the middle, see 30th September benefits are being paid, 30th September contributions are being received. So therefore, there is one assumption that is made, which is compounding happens half yearly. Now this is assumed. So I have just given you the working under the heading assumptions for academic purposes. Okay. Any contribution paid into or benefits paid from the plan will always be in the middle of the year. See, initially what had happened was this question did not have this date given. 30th September jo tha na, this date was not given. So this was the assumption which was made, will be in the middle of the year. But now that assumption becomes redundant because the date on which the payment is given, on which the payment is made, is given in the question. So there are two things. One is the interest rate given is always the effective interest rate, which in this case is 10.25%. This is one assumption. Second assumption is compounding happens half yearly because any benefits paid into the fund or paid out of the fund, any contribution into the fund or benefits out of the fund is always happening in the middle of the year. So these are the assumptions which are made. So you stick to those assumptions. Otherwise, your answer will have some minor variations. So to convert effective interest rate into a 6-month interest rate, it works out as 1 plus annual internal rate of return raised to 0.5 minus 1. So this is the formula. Okay, so the 6-month rate comes to 5%. The 6 months rate comes to 5%. You can check this out. Okay, 0.5 means you're taking the square root. Okay, minus half, minus 1. So that gives you the interest rate of 5%. Okay, so if I have to now do the accounting, 10 lakhs is the opening balance for 2019-20 at 10.25%. This is for the entire year because this contribution was there for the whole year. So 10 lakhs into 10.25%, 1,02,500. Return on 3 lakhs for 6 months at 10% normal rate. At 10% normal rate. What is this 3 lakhs? Inflow of 4,90,000, payment of 1,90,000. Both of them are happening exactly on the same day. So therefore, net inflow is 3 lakhs. Net inflow is 10.25 is given to you in the question. 10.25 is given to you in the question. Okay. See, this is what the fund is actually earning. Okay. The fund got an interest and dividend income of 9.25. The fund had unrealized and realized capital gains on plan assets 2%. And to run the fund, there was administrative cost of 1%. So the expected rate of return is 10.25. This is actually how the fund's rate of return is actually calculated. Okay, so this is given. We are just converting it into normal rate of interest, which is 5%. Okay, 1 plus annual IRR raised to 6 by 12 minus 1. Okay, fine. So is it okay? Just confirm. Yes. Okay. See, this is given in the question. Okay, fine. 1 plus raised to 6 by 12 minus 1. So 1.1025 raised to half minus 1. So 1.1025 raised to half is nothing but the square root if you are aware of it. Okay, so this comes to 1.05 minus 1, 0.05 or 5%. Okay, now what is the meaning of this 10.25? See, I have invested money in a fund. That fund is getting interest and dividend income. Now that interest and dividend income amounts to 9.25% of the fund balance. So this is one return which is accounted. The company made the following estimates based on market prices. So 9.25% becomes your interest and dividend yield. The second one is on the fair value of your plan assets. Opening, what was introduced in the middle and what is there in the closing. The difference on account of fair values, realized and unrealized gains, this amounts to 2%. So on a fund, you are having two types of returns. One is returns relating to interest and dividend, which you are realizing. The second is returns relating to capital appreciation. So in this case, the interest and dividend returns amounted to 9.25. The realized unrealized gains, that is basically your capital gains, amounts to 2% of the fund value. However, to get this return, you will have some administrative cost of the fund. You will have a fund manager, you will have people below him, you will have certain brokerage costs, certain commission costs that will be incurred. You may have administrative costs to have a separate office for the fund. So all those costs put together amount to 1% of the fair value of your fund. So ultimately, the net income that you are getting from the fund is estimated to be 10.25%. Is estimated to be 10.25%. This is how they have calculated. In real life also, the returns are actually calculated like this only. Okay, the returns are calculated like this only. All right. So once this is done, the estimate that we are now, the assumption that we are now making is this rate of interest is your effective rate of interest. This is your effective rate of interest. So therefore, if I have to convert it into an actual rate of interest, it comes to 5% for 6 months. 5% for 6 months. Okay. I've shown you how it pans out. Okay, 1.1025. The square root of that is 1.05. So 5% for 6 months. Coming to our workings. 10 lakhs is the opening balance. 10 lakh is the opening balance. This was invested for the entire year. So 10.25%. So 10 lakhs into 10.25%, 1,02,500 is the return which you are getting. This includes capital appreciation, dividends, interest, administrative cost adjusted, everything. On the fund, you have received contributions of 4,90,000 and paid 1,90,000. So there is a inflow of 3 lakhs, a net inflow of 3 lakhs in the middle of the year. So that is not there for the entire year. So we will take it based on 10%, or you can straight away do 3 lakh into 5%. You will get 15,000. So this is your expected return. It's not your actual return. This is your expected return. 1,17,500. 1,17,500 is actual return. This figure goes to the P&L. This is like your interest, dividends, capital appreciation, etc. But your actual return is 2 lakhs. Your actual return is 2 lakhs. So the difference between 2 lakh and 1,17,500, this is your actuarial gain. This is your actuarial gain. Your fair value has increased, and therefore 2 lakhs was your total return, out of which you are able to identify an expected amount of 1,17,500. The remaining 82,500 is nothing but your actuarial gain on plan assets. The loss on current, the loss on the obligation, actuarial losses on the obligation was 6,000. So loss is 6,000. So therefore 76,500 is the net actuarial gain to be recognized in other comprehensive income. Expected return on plan assets will be based on the market expectations at 1/4/2020 over the entire life of the obligation. Okay, so that is basically talking about this 10 lakhs. Okay, this is based on 10.25%, okay, over the entire life of the obligation. Have you understood? Yes. Did you understand this part? Rashmi, Kaushiki, Shailendra, Sanjay, Saksham, आई बात समझ में? Yes, clear? Okay, fine. Good to go. So that takes care of this. Now we move on. This I'm leaving it with you for homework, because I'm doing a similar question number 15. Okay, so please do question number 9. You can appreciate it is similar once we do question number 15. Okay, so come to question number 15. You can mark this as extremely important. Whatever we have studied so far, all the things are summarized in this one question. All the things are summarized in this one question. So it's a very summarily it is a very important question. Okay, so now look at the question, please. Arunachalam operates a defined retirement benefits plan for its current and former employees. Okay, given the large size of the organization, it engaged a firm of actuaries for advice on the contribution levels and overall liabilities of the plan to pay the benefits. The following details are presented. 1st April 2019, the actuarial valuation of the present value of the obligation was 15 crores. So opening balance, if I have to tell in simple words, present value brought forward is 15 crores. Present value brought forward is 15 crores. If I have to do it in the accounting manner, opening balance brought forward is 15 crores. Opening balance brought forward is 15 crores. Next, on the same date, the fair value of the assets was rupees 13 crores. Assets of the plan was rupees 13 crores. So you are having fair value of plan assets 13 crores. If you do account form, opening balance brought forward 13 crores. So my net obligation is how much? My net obligation is 2 crores. My net obligation is 2 crores. Okay. Coming to the next part. On 1st April 2019, the annual market yield based on government bonds was 5%. The annual market yield based on government bonds was 5%. Okay, fine. That is the rate which is given to you. During the year ended 31st March 2020, Arunachalam made contributions of 1.75 crores into the plan. So what is this? This 1.75 crores is your contribution. It is increasing the plan assets. So 1 crore. This 1.75 crore is increasing the contributions. Okay. So if you look at plan assets, to contributions paid. 1,75 crore debit. 1,75 crore debit. Okay. Next, let us read. The plan paid out benefits. Plan paid out benefits of 1.05 crores to retired members. Okay. So plan paid out benefits means what? I am drawing 1.05 crore from asset and I'm paying it out towards the obligations. That means what? My obligation also is coming down. My assets are also coming down. Obligation also coming down. Assets are also coming down. So if you see 1.05 crore is reduced in the form of benefits paid to employees because I have to draw the money from the fund, and the liability also is going down by 1.05 crore. 1.05 crores. Okay. So if you look at 1.05 crore, benefits paid, it will be credited to the plan assets account, and benefits paid will be debited in the present value of defined benefit obligation account. If you do a netting up, if you do a net presentation, then this 1.05 crore will not come only. This 1.05 crore will not come, or even if it will come on both debit as well as credit. Credit why investment came down, debit why obligation came down. So you show it, you don't show it, it won't make any difference. Okay. So it will not come when you do a netting off. Okay. Next. The actuarial firm estimated that the current service cost for the year ended 31st March 2020 would be rupees 1.55 crore. Current service cost means employees have given the service today, that is giving them entitlement to the obligation in the future. So it increases the obligation. So therefore, current service cost increases the liability. Current service cost increases the liability. So you can see here in the obligation account, I am crediting 1 crore 55 lakhs. I am crediting 1 crore 55 lakhs. So far, is it okay? Yes. Any doubts till now? Till now, do you have any doubts? Bolo. Do you have any doubts till now? Okay, no doubts. Fine. Let us proceed further. On 28th February 2020, the rules of the plan were amended. Rules of the plan were amended. Yaad karo, 1% became 2.5%. This was a plan amendment. And because of this plan amendment, what had happened in our case? In our case, the obligation had increased. Because the obligation had increased, I had taken the impact where? I had taken the impact. Where have I paid the obligation, Kaushiki? In our question so far, whatever we have done, obligation is not paid only. In whatever questions we have done so far, there is no obligation which is paid out. Okay, you can check any of the questions that we have done. Obligation ka payment hua hi nahi hai. Okay, there was only obligation building up. Obligation increase हो रहा था. मैंने obligation का physical payment किया नहीं था अभी तक कौन से भी question में. This is the first time we have made an obligation payment which you are seeing. You can refer to any of the questions. Okay. All right. So, okay. So इसके बाद let us now proceed. But I'm happy because at least you are alert and you are questioning. Okay. So coming to the next part, see, the rules of the plan were amended with retrospective effect. That means this is a plan amendment which led to an increase in the present value. That means what is this? This is nothing but a past service cost. In our example, 1 crore became 1% became 2.5%. We amended the plan retrospectively. So on the date of amendment, we took that impact in the profit and loss, but it is increasing the obligation. So in this case, it is a past service cost, which is increasing the obligation. 37 lakh 50. Past service cost increasing the obligation, okay. Are you able to recollect this? Yes, we had taken this to the profit and loss. Are you able to recollect? Yes. Are bolo Rashmi, are you able to recollect? Yes. Past service cost, Ratna Limited, 1%, 2.5%. Yes, okay. All right, let's proceed further. During the year ended 31st March 2020, Arunachalam was in negotiation with employee representatives, okay, regarding planned redundancies. These negotiations were completed shortly before. So the negotiations were completed shortly before the year end, and the redundancy packages were agreed. The impact of these redundancies was to reduce the obligation, reduce the present value of obligation by 2 crores. Arunachalam made payments of 1.875 crores to the employees affected by redundancies in compensation for a curtailment of their benefits. These payments were made out of the assets of the retirement benefits plan. Fair enough. So now please pay attention. See, redundancies means what? I had to do some laying off. मुझे employees को निकालना था. So I removed the employees. Now see, my obligation, I'm just giving an example. Okay. My obligation is accounted assuming my employees will stay for the next 10 years. Assuming. Okay. But suddenly in the 7th year itself, I am removing those employees. If I remove those employees, do I have to pay them their obligation? Definitely you have to. Will you pay them the entire obligation? Answer is no. But this obligation you would have initially booked for the entire 10-year period. Yes, sir. But you are paying the obligation today, right now. So will you pay the full amount or will you pay a reduced amount? Sir, I will pay a reduced amount. So supposing that the obligation was worth 2 crores based on a 10-year calculation, when you pay it today, we are saying we will pay you 1.875 crore. Are Baba, you would have to stay for another 2 years and then get 2 crore. But what I'm now doing is I'm making the payment right now today itself, 1.875 crore. And after that, mere se kuch mat mango. So therefore, can I say that I am paying 1.875 crore today to settle an obligation which is worth rupees 2 crores? Can I say that? Yes, that is exactly what is happening in this particular case. The obligation's present value was to be reduced by 2 crores by making a payment of 1.875 crores. So how do I give the effect of this? First thing, I am making a payment of 1.875 crores. So payment has to be made. So wo payment kahan se jayega? Sir, that payment will go out of the plan assets. So 1.875 crore curtailment and settlement. Curtailment क्यों? I have curtailed their benefits. मैंने उनको निकाल दिया. I have thrown them out of the organization. Because I have thrown them out of the organization, I have to curtail their benefits, reduce their benefits, pay off that. and because I have reduced their benefits, I have to settle the obligation right now. तो इसको हम लोग बोलते हैं curtailment and settlement. So this 1,87,50,000 is what I have paid off. Is what I have paid off. Is it understood? Yes. Is it okay? And by virtue of this payment, my liability is reducing by how much? Sir, my liability is reducing by 2 crores. My liability is reducing by 2 crore. Okay. This should not be gain on settlement. This should be curtailment and settlement. Okay. Just make that change. Curtailment and settlement. Okay. So now what you will say, sir, abhi benefits paid either 1 crore 5 lakh tha, either 1 crore 5 lakh tha. But here you are having 1 crore 87 lakh 50,000, but corresponding idhar hai nahi, hai na wo, it's included in 2 crores. Sir, but a liability of 2 crore came down, correct? By making a payment of 1 crore 87 lakh 50, correct? That means हमारा gain है 12.5 lakh का. I am having a gain of 12.5 lakhs, which is 2 crore minus 187,50,000. है ना sir? वो gain कहाँ जाएगा? That gain will go in the profit and loss account. Gain on settlement. This is extract of P&L. This gain on settlement is going in the P&L. How did I calculate this? 2 crore minus 1.875 crores. 2 crores minus 1.875 crores. So that comes to 0.125 crores. That is 12.5 lakhs. Is it understood? Yes. Curtailment and settlement, did you understand? Acha, ye past service cost also hits the P&L. So that has come here. Current service cost also hits the P&L. That has come here. Is it okay? Yes. Have you understood this part clearly? Yes. All right. Let us move on to the next part. On 31st March 2020, the present value of the obligation was 17 crores. Fair value of the assets was 14 crores. Fair value of the assets was 14 crores. Okay. तो ये क्या हो गया? This becomes my obligation balance 17 crores. Fair value of assets balance 14 crores. 14 crores balance carried forward. 17 crores balance carried forward. Is it okay? Yes. Now what we have to do is, the difference between this represents two things. That is, the difference between represents actual return on assets and actual cost. But these actual return can be classified into interest cost as well as actuarial remeasurements. So what we do is, we will first calculate the actuarial cost. We will first calculate the actuarial, we will first calculate the interest cost. Actuarials will come as a balancing figure. Actuarials will come as a balancing figure. Okay, so now in this case, opening balance is 13 crores. The rate of interest, annual market yield was 5%. Fine. So 13 crore pe 5%. 13 crore into 5%. Interest income 65 lakhs. Interest income 65 lakhs. Same thing, you will have a cost also. 15 crore into 5%. So that gives rise to a cost of 75 lakhs. That gives rise to a cost of 75 lakhs. And now when you take the balancing figures, the balancing figure is coming as an actuarial loss of 2 crore 37 lakh 50,000 for the obligation and a gain of 1 crore 52 lakh 50,000 for the plan assets, for the plan assets. Okay, so this is how you will do that. Coming to the net amount in the statement of financial position, coming to the net amount, opening balance 15 crore tha of the obligation, 13 crore of asset. So net what you will be presenting, negative 2 crores. Closing balance 17 minus 14. So obligation of 3 crores. Obligation of 3 crores. What all goes in your profit and loss? Current service cost 1 crore 55 lakhs. Already we have given the impact. Past service cost 37 lakh 50,000. Gain on settlement we discussed 12 lakh 50,000. Interest on the obligation is a cost 75 lakhs. Interest income 65 lakhs. So the total employee benefit expenses on account of this comes to 1 crore 90 lakhs. 1 crore 90 lakhs. Coming to the next part. If I have to look at my other comprehensive income, 2 crore 37 lakh 50 minus 1 crore 52 lakh 50, there is a net impact of 85 lakhs. There is a net impact of 85 lakhs. Is it okay? Yes. And if I look at cash bank extract, I have made a contribution of 1 crore 75 lakh. So that will come as a contribution. Is it understood? Yes. Did you understand the question in totality? मेरे को सही से बताओ अभी. Did you understand the question in totality? It is a very, very exhaustive question. Okay, a very, very exhaustive question, a very beautiful question. It covers everything. Okay. Exam se ek din pehle, when you are sitting to revise and you are under lot of stress and tension, exam se ek din pehle in DS 19, just study this one question and go to the exam hall. It covers everything, practically everything related to defined benefit plans, defined benefit obligation, plan assets, सब कुछ आ गया इसमें, everything is there. So you just study this and go to the examination hall for Ind AS 19 defined benefit obligations. Rashmi, did you follow? Kaushiki has confirmed. Shailendra, did you guys understand? Yes. Okay. All right. Fine. So that was a major question which we had to discuss. Now coming to question 9, you can see 1st April fair value of assets were valued at 20 lakh 40 and obligation was 21 lakh 25. 31st March, plan received contributions, paid out benefits of 255. Current service cost is given. Interest rate of 5% applied. Closing fair value is given. Provide a reconciliation from opening balance to closing balance. I have shared the solutions, Kaushiki. It is there on the assignment portal. Okay, you can download it. It's already uploaded. Okay. It's there. So note section has this PowerPoint and the solutions section contains this file. ये जो file है ना, which where मैंने कलाकारी किया, it's already updated there. Okay. All right. So if I had to, so this you can do it for homework. बहुत ही ज़्यादा आसान है. There is no curtailment and settlement here. खाली opening obligation, closing obligation, interest, opening assets, closing assets, contributions and payouts. Just this much is there. So question number 9 should now be easy for you to solve. Okay. So question 15 is done. Now the problem is recognition of assets. Okay. right to reimbursement. Okay, you will recognize a right to reimburse only when it is virtually certain that some other party will reimburse some or all of expenditure required to settle a defined benefit obligation. So you recognize the right to reimbursement as a separate asset measured at fair value. So take for example, you are a manpower company, okay, M Limited. You are a manpower company, M Limited, okay, and you are providing your services to another company, A Limited. So now, if A Limited is going to reimburse something towards your defined benefit plans, then only M Limited can recognize the right to reimbursement as an asset. This right to reimbursement will be recognized only when it is virtually certain. मतलब written contract होना चाहिए at least. Okay, virtually certain means there should at least be a written contract. Okay, it's a very high degree of certainty, say more than 95% certain that A Limited will provide some reimbursement. So when that is the case, that another party will reimburse some or all the expenditure required, then you will recognize the reimbursement right as a separate asset measured at fair value. Okay. Disaggregate and recognize change in fair value, same as that of plan assets. So do the same working as of fair value of plan assets. Components of defined benefit cost can be netted off against changes in carrying amount of right to reimbursement. Okay, so जो cost है, you can net it off. You can net it off against the changes in the carrying amount. Okay, so just go through this. It's fairly simple. Okay, you have these disclosures like what all you have to disclose, characteristics and risks, amounts in financial statements, disaggregation, assets owned, occupied, used, etc., actuarial assumptions, sensitivity analysis has to be done. Okay, like if your discount rate goes up by 1%, what is the impact on the obligation? Discount rate comes down by 1%, what is the impact? If your attrition rate goes up by 1%, what's the impact? Goes down by 1%, what's the impact? You will have to give a sensitivity analysis. And then any asset matching strategies used, including use of annuities, swaps, etc. Any funding arrangement that would affect the future contributions. So this was everything related to post-employment benefits. Then you have something known as other long. Now the principles remain the same. Okay, long-term benefits mein principles remain the same. Up to it's just a matter of application. Okay, other long-term employee benefits means this is when the employee is in employment but उसको कुछ benefits मिल रहे हैं. For example, long-term paid absences, jubilee or other long-term service benefits. Employee works for 15 years, he gets a reward. Okay. Long-term disability benefits, profit sharing and bonuses, deferred remuneration. Okay. So if benefit depends on length of service, obligation arises when service is rendered. If benefit is same regardless of years of service, obligation arises when event occurs that causes long-term disability. This is related to specifically the disability benefits. This is specifically related to the disability benefits. Okay. Measurement of obligations based on probability that payment is required and length of time. So how you will recognize? Same thing, no change. Deficit surplus आएगा, reimbursement right आएगा, recognition in P&L or the asset is exactly the same. There is no change in that. Okay, same as applicable for post-employment benefits. Okay, so if we pull out this question, you should be able to do this. Okay, Indrayani, you want me to do this question or would you like to try it as homework? It's just the same like what we have done so far. Okay, the Arunachalam question was quite a detailed one, so I think you should be able to try it. You want me to explain this or you will try this out for homework? Want to try this out for homework? Bolo. You want to try this out for homework? Okay, so please do this as homework. It's exactly the same. Okay, see, present value of obligation opening closing, fair value opening closing, interest cost income, current service cost contribution, past service cost, return on plan assets, benefits paid to salesmen, actuarial gain on the liability. So here they have in fact given the calculations. You just had to plug in the amounts in the respective accounts. Okay, last one. So this is other long-term employee benefits. Last one is termination benefits. Employees को terminate कर रहे हो, so the triggering event is termination, not employee service. VRS आ गया, you tell employees by छोड़ के चले जाओ, we are giving you this service. So it is not a benefit for what he has served, it is benefit because you are terminating him. So benefits are payable either as a result of two things: decision to accept an offer of benefits in exchange for termination of employment. Second one is entity's decision to terminate employment before the normal retirement date. Okay, as a result of either of these two things. When to recognize? Obviously, it will be earlier of the date when the entity can no longer withdraw the benefits, or earlier of the date when entity recognizes cost for restructuring. Okay, so this is fairly simple theory hai. Okay, employee's decision, accept the offer, or restriction to withdraw the offer takes effect, whichever is earlier. Okay, no specific disclosures, measurement, enhancement to post-employment benefits as post-employment benefits. If it is expected to be settled within 12 months, short-term benefits. If not wholly settled, treat it as other long-term employee benefits. तो इसका अपना कोई treatment नहीं है. It is taking the borrowed treatment of short-term post-employment or other long-term benefits. Okay. So this is one last question on ये question अपने study module में है नहीं. Okay, I have just incorporated it. So we will just pull out this question and then we end the standard. Okay, after assessing the impact, one second, I'll open the question. Yes. After assessing the impact of the COVID-19 pandemic, which adversely affected its operation since Jan 2020, Enjoy Travel Limited decided to shut down one of its divisions towards the end of 1920, published a detailed formal plan of closure together with redundancies of employees and termination of their employment. The details of plan are as follows. Enjoy Travel expects the commencement of closure in 2021, completing the full closure by the end of 21-22. Okay, so obviously closure में उतना time लगता है. Offers to pay 13,50,000 to each employee leaving the company before the closure. मतलब तुरंत जाने के लिए 13,50,000. But closure के लिए you need certain qualified employees. So to carry out closure proceedings, total benefit of 22,50,000 is promised to all employees staying in the company until the closure is completed. Total number of employees affected by the closure is 400. Assumes that 100 of them will leave before closure, 300 of them will stay until the closure. How should Enjoy Travel recognize and measure termination benefits as at 31st March 2020 and 2021? Applicable rate of discount is 8%. Okay. First thing, what is the termination benefit ka value? Okay, what is the termination benefit ka value? Okay, see, benefit in exchange for termination. Benefit in exchange for termination. By what are you thinking? Dekho, 400 employees. See, please pay attention. 400 employees are affected. 400 employees are affected. That means all 400 are going to get 13,50,000. So 400 into 13,50,000, 54 lakhs, 5,400 lakhs. Okay, 5,400 lakhs. 300 employees are staying to complete the closure. So they are getting 22,50,000. That means they are getting 9 lakh extra. So this 9 lakh is not for termination. It is for service. It is for service. So 2,700 lakhs. So total benefit is 8,100 lakhs. Is this part clear? Is this part clear, everyone? कौन सा टर्मिनेशन बेनिफिट है, कौन सा सर्विस बेनिफिट है? इज दिस पार्ट क्लियर? यस, इज दिस पार्ट क्लियर? ओके, नाउ termination benefits payable within 12 months. देखो what they have said, 100 employees. See, when it decided 2020, expects commencement in 2021, and assumes that 100 of them will leave before the closure. So 2021 में ही खत्म करके चले जाएंगे by before 22. So therefore within 12 months, 100 employees into 13 lakh 50. So 1350. The remaining 300 will sit to perform the closure and then leave. मतलब they are leaving after 12 months. तो discounting कर दो. 300 into 13 lakh 50 into 1 divided by 1 plus 8%. Only 1 year. देखो एक साल बाद तो उनको जाना ही है. So therefore discounting only for 1 year. Only 1 year discounted. So that comes to 37 lakh 50,000. So this is 5,100. Value of termination benefits. Value for termination benefits. Acha, service benefits, you are having 300 into 9 lakhs, 2,700. So per year, 1,350 you are attributing. Per year, 1,350. This is attribution. This is allocation or per unit. So opening obligation was 0. Interest 0 on opening. Discounting factor at 5% nahi hai. This should be 8%. Second. Yeah, it should be 8%, not 5%. Okay. Current service cost. See, 13 lakh 50,000 into this rate is going to give you 1250. And at the end of year 2, you will pay the remaining 1350. So there is no discounting of that. This 1250 at 8%, you get an interest of 100. So ultimately, this is what is being paid off. This is what is being paid off. Is this part clear? Yes, up till now, जो मैंने बताया है, benefits in exchange for service. Is this clear? It's the same thing which we have been doing. Up till now, what we have done, is this clear? Benefits in exchange for service. कौशिकी, रश्मि, शैलेंद्र, अभी तक सब ठीक है? Yes, Shailendra ne confirm kiya. Kaushiki also has confirmed. Okay. Now, what will be the accounting treatment for this? Well, employee benefits expenses account debit to provision for termination benefits in 1920. This is 5,100. Ye wala figure. Okay. Payable within 12 months. Payment of termination benefits. Provision for termination benefits to bank 1350. Unwinding the discount finance cost to provision. Balance of termination benefits as of 31st March 4,050. Personnel expenses profit or loss account debit to liabilities other long-term benefits 1,250. Okay. So this is what you are going to pass in 2020-21. Is it okay? Yes. Yes. ये समझा? 1920 did you understand? 1920 we are booking this expense of 5,100. That is termination benefits. That is, yeah, 1920 we are booking the termination benefits. Okay. 2021 we are paying off the termination benefits. 2021 we are paying off the termination benefits. कितना पेमेंट कर रहे हैं हम? 1,350. सो प्रोविजन फॉर टर्मिनेशन बेनिफिट्स टू बैंक. ये कौन से लोग हैं? ये वो लोग हैं जिनका पेएबल विद इन 12 मंथ्स था. दीज आर दोज पीपल हुज termination benefits are payable within 1 year. So that is being paid off. 1,350. Then you unwind the discount. So finance cost on this 3,750 at the rate of 8%. So you unwind this discount. So the provision for termination benefits increases. Now what is the balance in this 5,100 you had created? You have paid 1,350. You have added 300. So that gives you how much? 5,100 minus 300. Sorry. Plus 300 minus 1,350 plus 300. So that gives you 4,050. Okay. Then other long-term benefits cost for 2021. I should recognize 1,250. So I have recognized 1,250. 21-22, you will pay this off in cash. So that is done. Balance of termination benefit is 0. Unwind this 100 and pay off this 1,350, 2,700. Okay. So 100. Recognition of other long-term benefits 1,350 and pay off the other long-term benefits 2,700. So you have paid off all the long-term benefits and balance at the end is 0. Is it okay? Have you understood this? Yes. Kaushiki, is it clear? Rashmi, did you follow? कुछ है नहीं, it's just passing entries for whatever we have studied till now. Nothing specifically new. Okay. आई बात समझ में? Did you understand? Yes. ध्यान से कर लो, समझ में आ जाना चाहिए. It's not difficult. Okay. Basically, my services are divided into termination benefits and other long-term benefits. Termination benefits are paid off in the first part, okay, over a 2-year period, and the long-term benefits are also paid over a 2-year period. Beyond 1 year जो था उसको मैंने discount कर दिया. So I am obviously going to have to recognize the unwinding of the discount in the second year for both the types of benefits. And in the second year, both of them are getting paid off. So that is all that is there. The important part in this question was recognizing what are termination benefits and recognizing what is service benefits. This treatment is very important. Ye fix ho gaya, then you can have the remaining what you can say, then you can have the remaining calculations coming out correct. Okay. So that takes care of this question. Okay. Now, these are two appendices which are there, Appendix A and Appendix B to Ind AS 19. इसमें कुछ practical जैसा कुछ है नहीं. It's purely theory. Accounting for contributions from employees or third parties. How to take the item as a reduction in service cost, or there is no need to take it as a reduction. So just go through this for homework, but it's largely theory. Okay, largely theory, इसमें कुछ है नहीं. Okay, so these are just some appendices. Concept of economic benefits available, principles relating to availability, minimum funding requirements, etc. etc. ये सारी चीजें just पढ़ लो, so that you know that something of this type is there, but chances of it coming in your examination is very remote. Okay, all right, so that takes care of Ind AS 19 in totality. Okay, we have discussed everything. Okay, disclosure, certainty, defined benefit, other long-term benefit, termination benefits, recognition. Okay, yeah, so this is the appendix which I have put it in a chart form. Okay, ये वो appendix है, please पढ़ लीजिएगा. It should be helpful to you. Okay, and then we have done quite a number of these questions also, and we've seen some RTP questions also. Examination में कई बार ये आया नहीं है, but it has come in a couple of RTPs, and whatever has come is doable. Like that Cisca Limited का जो question था, that has come once in an exam, I think for 8 or 12 marks. Okay, so I think in that sense the standard is important. थोड़ा complicated है. Particularly the most important one is defined benefit plans, defined benefit obligations. Otherwise the rest of the standard is quite manageable. Okay, so I hope you guys understood. Any queries, any doubts? Any queries, any doubts? Oh, my mail ID. I used to get your mail IDs earlier. I don't know. Okay, fine. So mail ID is fr-final@icai.in. fr.final@icai.in. You can put your queries here. Freely ask. Don't hesitate to ask. Okay. Don't hesitate to ask. Is it okay? Was the session fine? Did you understand, Rashmi, Shailendra? बात समझ में आ गई? Kaushiki, did you follow? Rashmi, did you follow? Okay, okay then. If everything is clear, good. If there is any doubt, please feel free to ask. Please write. Institute will forward the queries to me and I will revert. Okay. All right then. Thank you everyone. Take care and see you guys. I think 9th February or something we are supposed to meet. Okay. So see you that day. Okay. Yeah. All right. Thank you. Take care. Bye-bye.